validation, now I validate myself. Building inner strength, putting doubt up on the shelf. No more unnecessary drama, no more wasted time. Climbing higher constantly, making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. Whoa. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we're talking about this, that, and everything in between. Whew. Man, we didn't have us a week ahead of us. I gotta tell you, today's Tuesday. I thought today was Wednesday for like the largest part of the day. Man, I was like, I went outside. I was like, man, the garbage man ain't gonna pick this shit up yet. Like this shit been out here forever. And then I look like halfway through the day, like it ain't even fucking Wednesday yet. Damn. Time is flying and dragging at the same time. It's just, you get discombobulated when you're doing nighttime and daytime at the same time. But hearing that, I tell you guys on a regular basis, This and That, live every night of the week, and we do not let the sun rise without going live. But we don't always start on time, and that's why we ask you guys to like and subscribe, and then hit those notification buttons, smash those reaction buttons, and then also take the opportunity to go and look at that membership. Today we're going to talk about money, but every night of the week we have a different topic. They have not put boots on the ground, so I'll be giving you guys updates on that if they do. But Sundays, we typically have questions and comments from the fans, appropriate questions about stuff that y'all need to do, and then I give y'all the answers for that or add recommendations that can aid you guys in heading in the direction that you're trying to go to. Then we have Monday, Tuesday, Wednesdays about business and politics, where Monday we talk about different ways that you can negatively be impacted by politics, because politics, but geopolitical trades, all this other stuff, it negatively impacts your ability to make, save, and invest money. So what we do is we tell you guys what's going on and how it impacts your money, and then what you can do to avoid it, right? Well, or mitigate the situation, hedge the situation, because like right now, none of us can control the gas prices, but all of us have to pay for it. So there is a way that you can make a little bit of money back on this situation, but it does require you guys to be able to put your money in the right spots. Now, there have been some situations like a couple times on the show where I have put links on the show for you guys to have gas apps that help you guys get rebates on gas or reduce money on gas. So I want to talk to you guys about that, and then get back to which, now I think about it, you know, I went out there to go get some gas at the pump the other day, and when I went, I had used that car advice situation. And the concern that I have, not really a concern. So they said that there's supposed to be a rebate on it, right? And we used it, and I haven't followed up on the transaction yet, but did we get the charge? It should have been a $60 charge somewhere, which I don't see, which is interesting. um, $43. What is that? Oh, that is something else. So, and the reason why I'm looking at this real quick now that I'm talking to you guys about it is because I think it was like the 16th when we went. I had talked to you guys that day. We were talking about going to use some of these gas cards, these rebate cards. There it is. Murphy's, $48.12. Oh, so it took $28 off of the damn. Okay, I ain't mad at it. Either way, we were looking at the ability to purchase gas and then get the rebates off of purchasing the gas. And I told you guys that I was going to monitor that stuff and then let you guys know what's going on. Now, I'm going to be touching base with them and getting some information and then giving y'all an update on that, because this is actually quite interesting. Uh, because there's this app that is, and I don't get paid for any of this stuff. So this isn't an affiliate promo or anything to that effect. I'm just using this shit. I know that it puts money back into your pocket for some of these things. And when I be talking about it, I'm like, yeah, if I got money back, I'm gonna tell you, hey, gas is high as fuck, but if you use this card, you'll get you some money back on your gas prices. So I'm going to call people up about this one and get more details about it and find out what's going on with that particular situation. And then they'll give me some information on it. Then I will be able to give you more information about this. Is called Car Advance, and I told you guys that you pay like $4.95 to get the card. They mail the card to you. You get it pretty quickly, and then after that, you use the card, and you're supposed to get rebates off of the card. And when you get rebates off of the card, you end up getting your money back like in rebates. So if you use the gas card like 2 or 3 times, and they give you like $5 or $10 back, because it's supposed to be 5 cents off. Well, yeah, 5 cents per gallon off is technically what they're supposed to be doing. So um, when they're supposed to be giving you the 5 cents off per gallon, it's supposed to show up on your account as like a PayPal transaction or something like that. And I didn't see it this time, so I'm going to double check it the next time, and then I'm going to find out from them about the rebate so I can see where it is so I can show you guys. That's what I'm looking at right now. Now, Upside is one of those other places that if you use it, you get rebates back on it. It's a free thing. You don't have to pay for anything. Don't have to put any money on the card or anything. You just scan your location or scan the pump or whatever the case may be, depending on where you are and whether or not your GPS location is on. And what happens is when you use it, and you sometimes have to scan a receipt, but when you use it, you get money back on the card, on the account, and then you can put that money onto your PayPal account. So it's one of those things that I talked to you guys about, because it gets you up to 25 cents a gallon back on your purchases. So while Car Advance will give you like 5 cents a gallon back, and then Walmart.com will give you like 5 cents a gallon back, and then Upside gives you, depending on which pump you're going to, up to 25 cents a gallon back. So you want to check to see like what's going on and how that stuff works. Now, that's my to-do list, but we give you guys information about, ways to navigate past the fact that gas prices are high, including but not limited to, hey, go invest in a certain number of stocks, and you can find yourself getting money back on a certain number of stocks, because those are dividend paying stocks. Now, right now, I got some growth stocks going across the screen, but usually we have some of the dividend paying stocks going across the screen as well. That helps you guys pay attention to which stocks that you can make, save, and invest money on. Then Tuesdays, we talk about places to make money, save money, invest money, budget money, and that's where we are today. We're going to be talking about the dividend rotation strategy for June and July, right? So we're going to be going into detail about some of the stocks that you should be paying attention to. These are undervalued stocks, especially during the current geopolitical conflicts. And we're going to be following up on these. This is some of, I believe, 54 undervalued stocks that we've been watching over the past year and a half now. So we're telling you guys what they are, what they're doing, and approximate estimations for their ex-dividend dates, so you guys can pay attention to that. Also, those stocks are in the membership, are going into the membership, notifying you guys of when these dividend dates are pending. Now, you want to go and do your own research and see if any updates changes the ex-dividend dates. But if you're trying to acquire these stocks before the ex-dividend date, the goal is for you to see which ex-dividend dates that I'm talking about. And I want to say 5 days ahead of time, you want to put your money down on that stock. Now, why do I tell you 5 days ahead of time? Because typically within a week of the ex-dividend date, a lot of stocks have a bit of a dip. Then it has a climb. If you get that dip, then you can buy in lower than what the ex-dividend date value will be the date of the ex-dividend date. The ex-dividend date is the first date that the stock sells without the dividends in it. So whether it's a 12-cent dip, whether it's a $1.25 dip, for the dividend payout, it will experience that dip, and you just have to be there when it happens. Now, that dip, sometimes it bounces back, sometimes it doesn't. But if you bought in lower than where it peaked, when it drops the dividend value, it is still far above what you paid in, and that is going to be the gain, whether if you sell. But if you are following some of the stocks, like me and Steven are following some of these stocks, a special shout out to Steven. Today is one of the first days of the stock party, so go in there and go and get your stock. I dove in it so quick, I didn't even see what stock they were getting, but they said stock party today, and I was like, boom, it's available for the next 5 days. So make sure that you get in there and get that. I already got my Tesla stock from last time, so it's exciting. It's not a lot of stock. They're giving me like 11 cents worth of stock. So, if they gave you a stock every week, they give you 52 stocks a year at 11 cents a stock on average, right? That it's almost like $2, $2.50. It's not like you're rolling in the dough, but the fact that you can get on the app and you can acquire free stock and then use that stock as a reference point. You can sell a stock if you don't have any value in the stock. I would say about 4 months after you get it, because if you sell it sooner than that, they'll likely cancel out the transaction of you receiving stock from them. But if you hold it and you're gaining shares and interest and stuff like that on it, like buy and hold, and then like 4 to 6 months in of ownership, you say, well, no, I want to kick the bucket on that stock. You can do that and keep the change off of that transaction. The wow thing is, though, is that if they give you specific stock like Amazon stock, Tesla stock, this, that, and the other stock, you actually can watch the rise and fall of that stock because it's in your portfolio. So instead of you having to go to the S&P 500 or going to the NASDAQ or going to the Dow or whatever, you actually have a list of them buggers on your profile. And you're like, oh, it's up or it's down, right? Because it's in your list. and you didn't have to put any money down to get it in your list, right? These are the things that we talk about on the show. Now, after Tuesday, we talk about on Wednesdays, we talk about different countries around the world that you can invest in and potentially live in, and sometimes be more affordable, sometimes not. Then we have Wednesday, Thursday, and Friday. We give you guys information about how to fix your personal life, self-development, personal improvement, um, uh, relationship topics, socializations, networking, building your brand, and then transitioning back into the workplace. We've already covered talking about your pay on the way in, but then we primarily, you got a job already. We talk about raises and promotions because I mean you can get a better raise or a promotion instead of just taking what they have to offer. Stephen just experienced that recently, where they offered him a specific pay raise amount, and it was a disappointing pay raise because it was half of what they originally would have offered, right? But his only discussion with them was why or why not. And by them not giving him the raise that he thought that he was supposed to get, he got mad at the boss and he didn't handle it as well as he could have handled it. I understand in the moment it got him frustrated. He forgot the area of the show we had talked about before, that when they tell you stuff like this that frustrates you, take a deep breath, maybe remove yourself from the room. Say, hey, I have to go to the bathroom, whatever the case may be. Give me a moment, let me come back to you real quick. Go to the bathroom, splash some water on your face, rethink your position, and then go back into the conversation head on, right? That is one of the best ways to do it. The boss tells you something that you don't like to hear. Now is not the time to flip out, because negotiations stop when you flip out. They say something that you want to hear, even if you don't get up right away, you know what I'm saying? You can put your head down a little bit, breathe, rethink your position, adjust your seat posture, whatever the case may be, look around the room and, whatever, just like before you speak, reduce your temper a little bit and then think about how to respond to that and then say something. Now, what you're going to say, what Steve didn't do, but I had said on the show before to do, is to discuss other things. Like they don't sell stock in some countries, in some companies that are private stocks that are not publicly traded stocks, but they may give you the stock, right? Make you a shareholder. So you got to talk to them about if that's a possibility and how would you go about doing that and who do you talk to get involved in it. Likewise, there's other things like they may not do the stock, but they may do other things such as extra PTO time, extra vacation time. They may not give you the full raise, but they will add performance bonuses. There are a lot of things that they can do that will benefit your ability to be successful. Now, what you have to accomplish with that is you have to make sure that you discussed something, extra sick days or something that can benefit you, that is not the actual pay itself, because not all the time will your employer give you a pay raise. That hourly rate has an hourly max, but the other benefits that the companies have that nobody ever talks about, because we get paid for our presence and that's all we get paid for. Some jobs that are like restaurants and stuff like that, they may not pay you extra money, but they might put you on a free meal plan or let you eat for free or something like that. Let you and some of your family members eat for free and discounts and stuff to that effect, where they're not paying you more money, but you can get your money's worth out of the food that you're allowed to eat at the job, which saves you money somewhere. So, you've got to really think about what does this company have to offer for its employees and what do you qualify for, then negotiate what to ask for, because it's negotiation. You have mandatory distributions based on a contract that you have, where they must give you a certain percentage of a raise based on the contracts that you have. Then you have voluntary distributions where they decide to give it to you because of how much they value you. Then you have the requested distribution, which is asking for more based on how much you believe your value is. Now, these three things happen 3 different ways, because your employer is going to give you mandatorily what they declare in their written agreement with you that they're supposed to give you. If it's a 1% raise, that's what you're getting, is 1% raise. If it's a 1% raise and a 2% bonus, that's what it is. It's a 1% raise and a 2% bonus. If it's a 1% raise and a Christmas bonus, then that's what they're going to give you. They're going to give you flat line what they said they're going to give you. Now, if they've already given you what they're supposed to give you after that, you got to ask for more, or you got to do more to earn more, right? So that's why I said you got to find other ways to talk about these things. And that's what we're going to be doing today. We're going to be talking about stocks today, but we talk about different ways for you guys to make, save, and invest money, right? And we talk, and after we finish talking to you guys about the promotions and the raises, then we talk to you guys about retirement. We talk to you about the forced retirement. We talk to you guys about the severance packages. And then we give you guys a lot of information on how to build your 20 or 30 year plan, because I mean, not a lot of people really pay attention to what their future holds for them. They just know that if I survive today, that tomorrow is another day. And I'm like, no, man, the shit you're going through today cannot continue to be this way. You need to have a way to make tomorrow better than yesterday, right? And that needs to be your goal. You need to be able to make tomorrow better than yesterday. One of the things I do with this podcast to make things better later on in the year is I am advance posting all of the shows for the next 6 months. In the process, I am also advance creating all of the scripts for the next 6 months. At some point over the next 2 months, I'm going to have the next 6 months worth of scripts dated and created, where I don't need to figure out what I'm going to do for the show. The show is already listed for the rest of the year, but I will also have enough time to do more things in my personal life. And I'll also be able to do things like edit the other videos that I haven't been editing over the past 2 months and stuff to that effect, that allows me to maintain performance and not be as stressed out, right? Making changes today so that tomorrow and next month and the month after that is better. These are things that can be done. And then being able to keep up with that trend makes it so much easier, because when you start setting up a pace where on your days off, you're putting up the next 10 days. And you got 2 or 3 days off a week and you're putting up 10 days at a time every 3 days, you got no beef, right? That makes things less stressful. So as I go through it, I start seeing more time, I see more space. I've done a lot of things in my personal life that I would not have been able to do if I was forever 18 hours a day just working, right? And that's what people don't think about, is that you can't just wake up every day and just figure that today I'm going to do the same thing I did yesterday. No, fuck that shit. Today, I'm going to do a lot of stuff today that worked for me yesterday, and a lot of stuff today that I don't want to have to do tomorrow, so that tomorrow I got less stuff to do. That's the main observation. Now, special shout out to Michael. Michael says, if IVF, if you're in the restaurant business, you usually get a meal per shift. Yes, usually, depending on what kind of restaurant you are at, you get at least 1 to 2 meals per shift, depending on how long the shift is. Because if you've got a part shift, like a 4 to 6 hour shift, they should feed you at least once. If you have an 8 to 10 hour shift, they might feed you twice. If you've got a 12-hour shift for some reason, like Dunkin' Donuts and other such places that do 12-hour rollover shifts, then you might have more than that. Then those places also allow for grazing. Why? Because since they don't always have a full shift, what they usually do is they allow you to get you a little snack when there's less customers around. So instead of you sitting there having a full meal, thinking about what you're eating, enjoying the way it tastes and this, that, and the third, you actually find yourself in a position where you might have to grab you a quick bite, a little appetizer, something to keep your stomach settled and get back to work. You might have to grab you a quick sip of a soda or something like that and get back to work. And that difference, you're looking at larger paychecks, no break time, even though we're supposed to get a 15-minute break every 4. Ultimately, you're supposed to get a 1 hour break out of every 8 hours, which is 2 15s and a 30. That's how it's supposed to be. 15 minutes in. So first 4 hours you get a 15-minute break. Second 4 hours you get another like 30-minute break, and then after that, whatever shift you got left, you're supposed to get another 15-minute break in there somewhere else. So in the course of like a 9-hour shift, total 9-hour shift, you're supposed to work 8 hours and get a 1 hour break. But not everybody does it. We work through the break because we're like, nah, fuck that. I can use that extra hour on my paycheck. He's like, Mike, I'm your personal AI assistant. With a personal AI assistant that's spelled if with a V. we'll work on that AI aspect of things. And you know what? Dang it, I do it every night. I swear up and down that I'm going to do it. I'm not getting out of this chair today until I mess around with those admin functions. Because usually when I get off I'm like, and then I take the dogs for a walk. Then I'm like, let me get something to eat. Then I got to feed the dog. Then I got other things to do. And I just walk away from it and I think to myself, I'll do it later. And then I completely forgot admin functions. But I'm going to get to it. You'll see that I did it because then we'll go live one day this week and Steven will be up there as a moderator also. But we'll get there. Now, while most investors are going to be glued to the markets every twitch, because we're talking about the stock market today, and they're nervously waiting for the next Fed announcement or the tech stock drama, they're missing a predictable income event that's quietly taking shape for this June and July. So it's going to be a small window where you can position your portfolio to capture a surge of dividend income that almost everyone else isn't planning for. So many people are going to be focused on the chaotic noise of the stock prices that they've become deaf to the steady rhythmic pulse of actual cash flow. They treat their portfolios like a lottery ticket. You notice how we had somebody on the show just yesterday talking about all of the silver that he bought, right? Silver's at $70, $75 an ounce right now, right? Highest it's been, right? And it's outpacing gold because gold is still right around 4,000 or 5,000 an ounce, right? And usually silver is 10% of the price of gold, which would essentially lead people to believe that if silver is hitting 75, that gold might hit 7,500. That's not going to happen. But this is what they're doing. They're treating their portfolios like a lottery ticket, hoping for one big unpredictable jackpot. The guy that's riding the wave of silver right now, when he was buying silver at $52 an ounce and they're at $75 an ounce, now he's holding that $75 an ounce. As soon as nothing. I am on page 2 of 62. I started about 28 minutes ago. So I didn't see your name in the comment section, so I was like, I'm gonna linger. We're gonna talk shit until Steven jumped in here. And then when I see Steven in here, then we're gonna get to today's topic. 77.27 per ounce today for silver. So that it's gone up $2 since the last time I looked at it on Friday. Which is fantastic. I'll be updating that information in the membership this afternoon. So anybody who's buying into it at $52 to $55 an ounce in January, it is now 6 months later $77 an ounce, where you're looking at like a $20 or $22 an ounce profit. Now, depending on how much money you got, if you got like 100 ounces, you might have just made 7,000 or not 7,000. You might have just made $2,000 worth of profit, which is fantastic. But the trick of the trade that people don't pay attention to with this is if you bought into it back then and then you sell it now and you get that $2,000, $2,200 profit back, then Uncle Sam hits you with that taxation on it at market rate. which depending on where you are in your market rate, that $2,000 might get taxed like 25%, right? Which means that your $2,250 might go down to like $1,700 after taxes finishes with it. But you still made you some money on it, right? Um, there's that. Uh, the difference with that is you only profit if you sell it. If you bought and hold back in the day, you ride the wave right now. If you sell it and then you buy it back in, you'll find yourself getting kicked in the nuts if you don't sell while it's high and then buy back in when it drops. If you just buy and hold and then after the war is over, because the war has to end for this price to drop. When the war ends, you will see the silver consistently depreciate in value. And once it depreciates your most recent buy-ins, you will be losing money, offsetting the money that you gain, where you end up breaking even. And the bubble of which you were making a profit will be gone because it is almost on the cusp of finalizations. Because again, we've got probably 30 more days of this. Somebody's going to do something radical or somebody's going to do something positive. It's not going to be a standstill forever, right? So, because of this resolution, I said the resolution was going to happen in June. No later than like July was what I was assuming when I started talking about this in February. While it is still volatile, you're going to look at the incredible growth of this portfolio. But once it falls in August, you're going to be sitting there like, shit, I could have sold in June. Micah says, you can think, you say, you can think it this way. A pre-1964 quarter is worth $14.04. A quarter, a 25-cent quarter, is now worth $14.04. Uncle Sam is Greek. Uncle Sam got a blank check for these soldiers, bro. Not for their families, not for their payroll, not their salary. They're getting flat rate based on their rank and years of service. But Uncle Sam got a blank check for blowing shit up. It's like, oh, you want to fuck somebody up? You don't even got. I already signed my name on it. You just got to put a number on there. I don't already how many zeros? You know what I mean? Then $2 trillion worth of military debt. Then they sell the debt to shareholders who are going to buy treasury bonds to pay that debt. It's a business, I gotta tell you. But yeah, they greedy as fuck. I don't think the war is driving the cost of silver. I may be wrong. Okay, so the war is indirectly impacting the drive of silver, and the reason being is because poor people can't afford gold. I'm just gonna throw it out there. Look, first and foremost, and when I say poor people, I mean like anybody that's not making $250,000 or more a year, like the 77% of Americans that could have done something different. Okay, so look, the whole stock market is negatively impacted right now. The whole stock market, because trade routes are volatile right now. All trade routes, because the fuel that transports all resources has been compromised. So every business that makes its money off of a physical item being shipped from one place to another, all of those companies are hurting. That means that the wealthy people who invest in these companies will pull their money out of these companies and put it somewhere, quote unquote, safe. And the cheaper of the two is silver. Because when people started buying into silver, when I started talking about this like 6 or 7 months ago, silver was 10% of the price of gold. Silver is undervalued because silver has the same demand, if not more demand, than gold, because gold is collected not just for a resource, but to back capital. Silver is collected for development. So the demand for silver is equivalent to the demand for gold, if not more so. It's just that the monetary value for silver on the stock market is 10% of the value of the price of gold per ounce. So anybody who wants to turn a profit off of silver would buy into silver until silver matches gold, right? You can have more silver per ounce, which means that you can have 10 times more gold. I mean, 10 times more silver. So at $77 an ounce, still a little under $100 an ounce for silver and 4,000 plus dollars an ounce for gold. See what I'm saying? For every $1,000 worth of gold, to have a quarter of an ounce of gold, you could potentially have 100 ounces of silver. Now, when it recalibrates and the value of silver starts matching gold, for each ounce of gold, for each ounce of silver you've got in comparison to the ounce of gold the other guy's got, you're going to have this more money when silver is matching gold because you have the same quantity of ounces of silver as somebody else has a quantity of ounces of gold. That's the thing. But like, yeah, it is going to be a ripple effect. And that's what we talked about on the show on Monday. It is a ripple effect. Geopolitical trades is a ripple effect on the stock market, and the stock market is going to ripple affect other markets. It's going to ripple affect Bitcoin. Tech is going to ripple affect Bitcoin and other cryptocurrencies. And gold, silver, platinum, uranium, and other precious metals are the safe haven in volatile stock markets. So when the stock market is negatively impacted by geopolitical tension, a lot of wealthy individuals and perceivably smart investors relocate their money towards precious metals. Silver right now is everybody's go-to. So that's the reason why silver is going up. Now, one or two things is going to happen off of this. Either silver is going to stay in its current position and gold is going to shoot up to 7.5, or a lot of people are going to sell that silver right after the war is over, and there's going to be a lot of people losing out on silver and a lot of people gaining because they sold silver $20 or $25 an ounce more than what they bought into it, and then they're going to buy back in when silver goes back down to $59 or $60 an ounce. Which means that they're likely going to make $20 to $30 an ounce worth of profit off of it before the war is over, right? He said, buy as much as you can and I'll explain. So people are looking for those one big lottery tickets, and they're looking for things like that to assume that they're going to make a big hit. But what if you can treat your investment portfolio like a business with predictable revenue hitting your account monthly, month after month, year after year, instead of that one perfect windfall one time during one political term, and then the rest of the time you're looking for the next big hit. Michael says AI data centers require silver. Not just AI data. Green energy is requiring silver. Tesla batteries and other such. The solar battery storage things and all of that stuff, the solar panels and everything like that, all of that stuff, your cell phone. So every iPhone that's sold, every Samsung that's sold, yeah, that stuff is got a lot of silver in there. He said there's a 200 per shortage of silver for the demand of it. You are definitely right. And that's why I said it's undervalued. It's excessively undervalued. And they have not reevaluated it. I don't know when they're going to reevaluate it. There's no like specific trend date of reevaluation. It's just undervalued, but it's in high demand. It's actually more accessible than gold. There's less gold in the world available than silver. He said, where I'm from, people make way more than 30 bucks off an ounce, but I don't think it's silver that they are selling. No, they're not selling silver. It might look like silver. Okay, so here's the thing. You have white gold, you have gold, you have silver, you have other metals that are like silver, like aluminum and other such that also make money. You have people who sell certain metals at the salvage yard and they're getting more than $30 an ounce for those metals, but those metals are not necessarily silver. You know, you've got nickel. Nickel has a monetary value on it, not 5 cents. I mean the actual metal nickel. It looks like silver, but it has a different dollar value to it. So there are some where you can sell some, you can take the silverware in your house and melt it down, and especially if you're able to separate the impurities, you're able to sell the silverware in your house and make you some money off of it, depending on how much of it is a reasonable quantity of metal. Yeah, solar panels, cell phones. Yep. Yeah, you made me feel rich. I'm glad I collected. You should. You should. Now, this isn't about some secret algorithm or a risky option play, because I don't talk to you guys about extremely volatile plays where the probability of loss is at 80%, but you're going to be the 20% that gets it. I don't do that shit. He said re-trigger. Re-trigger what? Special shout off to Mr. Hitler. You thought I wasn't gonna do it. Rizzler. Hey, you see how he tried that? Some people just put some of the strangest names on their profile. I don't know. So I don't give you guys like volatile things that are like so volatile. Like I tell you guys, buying into Bitcoin, extremely volatile. You're going to lose more than you gain if you don't know what you're doing. I always tell you guys to know what you're doing before you get into it. If you're going to get into it, I tell you guys, try trade bots, try Pionex with the trade bots and see what you can do with that. Start small, start with like $200 or $500 or something like that. Get used to it for a little bit. Then start adding more money on there, start adding more trade bots on there. Try to learn more about it before you start going all in with it, like 20, 30, 40, 50, $70,000. You don't want to buy a whole $50,000 Bitcoin and then not knowing what you're doing, lose the whole $50,000 worth of Bitcoin. You don't want to do that. You know what I'm saying? So that's highly volatile. But for beginners, for amateurs, for individuals that are investing, and I say, hey, get you, certain dividend paying stocks, like that's less dangerous. It's still a volatile market, but what you could lose in the share value, you would gain in the dividend distribution. And if you're holding the stock, as long as you maintain possession of the stock, when the stock value bounces back, you will make back the money that you lost when it dipped, because it's a dip. It's not a permanent slant. See what I'm saying? They're not going out of business. So I'm not giving you a risky option play. This is about a fundamental shift in how you see your portfolio, right? It's going to be about moving from a mindset of passive hope to one of active income planning. So tonight's show, I'm not just going to tell you about it. I'm going to show you the exact strategy to find and capitalize on what I call the summer income surge. Special shout out to Aztec. So we're going to turn your portfolio from a source of anxiety into a well-oiled income-driven machine. And it's going to start by looking at the quiet months of June and July. So let's be honest. For the average investor, looking at a portfolio statement is an emotional roller coaster. One day you're up, you're feeling like a genius. The next, a single headline wipes out a month of gains, and you're left with that sinking feeling in your stomach. This is what happens when you're only focused on the stock price going up, the value of the shares, what they call capital appreciation. That's not what we're supposed to be after. He said, indoor to keep up with inflation, you must be invested in the market. Yeah, that is true. In order to keep up with inflation, you must be invested in the market, and you must be invested to a magnitude that meets or exceeds that 10% return, because you have an average of 3 to 4% of inflation and an average of 3 to 4% of taxation on your total income, which is an average of about 7%, 7 to 8% of the total value of your money being depreciated off of the total value of your money every year. So if you're operating on 10% or more, then you're looking at a 3% profit on top of inflation. So year over year, your $100, the $100 that you have might lose 7% of value every year or 8% of value every year. But if you're operating at 10 to 15% return on investment, you're literally still gaining 3% more than what the market could depreciate. So while a lot of people are concerned that the United States dollar is depreciating in value and it's not going to be worth anything in 20 years, I mean, if the US dollar is being transactionalized like a peso, but you still got like 50 million of the motherfuckers, you're going to be doing way more than what you would if you were living from paycheck to paycheck. But we also know that from country to country, what is it, like 1,000 pesos is like a dollar? What is it, like a few hundred to 1,000 yen? Well, I think it's like a few thousand won is a dollar, or a few thousand yen is a dollar, or a few hundred yen is a dollar. It's almost like a 1 yen to a penny kind of thing. I don't know the exact conversion rates, but the fact is that you can go to Asia, and you could go to Asia with like 50 grand, and you could be millionaire status over there, multi-millionaire status over there, right? You can go to the Philippines with like 30 grand and be multi-millionaire status over there. 30 grand in America, and you're on Section 8, you're on food stamps, it's a lot of stuff going on, right? Big difference. Michael says, is Bitcoin something you can physically hold in your hand, or is it just electronic? Bitcoin is digital currency, so it is electronic. It is an algorithm. It is not something you can physically hold in your hand. If prices go down, I'll buy more. As prices go down, I'm continuous. I just put $300 down on some shit just the other day. My portfolio got a spike. Look, Steven, I was looking at that Roth IRA, and I was like, man, because I don't want to spend $129 a year until I know that I can get my money back off of that $129 a year for the membership to have the Roth IRA. Now, the Roth IRA allows for me to pick whatever stocks that I want to pick for the Roth IRA. But the problem is that in order for me to get my return on investment, I did a little bit of digging. Stash App will give you 3% off of what you put towards your Roth IRA up to the $7,500 cap, right? So if you're putting out the maximum amount that they're going to put the 3% against, that's like $252 to give you back every year. So you give them 129, they give you 252, but they put the 252 into your Roth IRA, right? Which is going to be like what, tax deferred or whatever until you get old as fuck. Now, that means, I told you guys I had to do the calculation before I see how this makes sense. $625 a month is the $7,500 for the Roth IRA. If you do it, I do believe like $635 or $640 a month. That includes the $129 a month that you got to give them in order to do the annual membership. Now, that means that you can put about $640 to $650 a month into your Roth IRA, and then when you top out your Roth IRA, you've got the $129 sitting there to pay for the annual membership. They have matched you and put in an extra $252 on your Roth IRA, which makes the money that you gave them zero out, and you still turn a profit off of that, which is actually more of a gain, because if you paid $129 and they gave you $252, you made what, $130 off of that shit, right? Or $120 off of that one transaction. Just doing that, that's a huge return on investment. Before we start talking about the dividend returns, before we start talking about the tax deference, before we start talking about the appreciations of value over the next 10 or 20 years, then this is the part that I thought was a phenomenal decision. It's like, if you're getting that $640 or $650 a month from your primary brokerage account, the dividends from your primary brokerage account, and you're putting that on your Roth IRA, then you don't have to do nothing. you put the money up onto well, the money's already up there on your account, which if you're doing 10%, it would have to be about $80,000. So for the average financially challenged person, this isn't like, oh, we're gonna do this tomorrow kind of thing. But you had about $85,000 sitting up in your brokerage account, and you take the dividends from your brokerage account and put it directly into your Roth IRA and put some aside to pay for the annual membership. The account pays for itself, and then defers taxes on like 7.5 grand of it. I was like, oh, okay, I'm gonna have to put this shit to work. And then Aztec, like, yep. That's why I don't understand people who go into the market and want to be conservative with the gains. The people are chasing the gains on the share value as if that's where the money is at, because that's what we were taught back in the day. You can buy any stock that you want, and the difference between what you paid for it versus what it's worth now is whether or not you made a profit or whether or not you made a loss, because you have to sell it. This is why this capital appreciation mindset is a no-go for the strategic investor. Yes, you can invest at the right time on a dip, experience the appreciation, have the gain value, still paying attention to the capital that's going into your pocket guaranteed, and not be as bothered by when the dip occurred, because a dip triggers a buy. Because when the inflation comes, when the appreciation comes, you have more growth on your overall portfolio. Those individuals that leverage their portfolio for capital, cash flows, when you have a certain portfolio value, if you know the average depreciation of it, like if your portfolio typically goes down 30% throughout the year, but it bounces back, you know that in order for you to play it safe on a capital loan, that you would have to take out 40, 50%, 60% towards the total amount, so that if there's a 30 or 40% dip, you are still at the precipice of the bottom line, where they're not calling you trying to sell your shares right now, because there's more than enough money in your portfolio to cover the market's behavior patterns. So if you had 100 grand, you wouldn't take out 80 grand just because you can. If you had 100 grand, you might take out 50 or 55 grand and do something with that, because if that 100 grand worth of value in gains depreciates to 70 grand worth of value, you still only owe them 50 grand worth of value or 60 grand worth of value, which means there's 10,000 extra dollars there that has nothing to do with what happened with the market. Now, one of the things that the average person doesn't think about with the gains is that gains on the capital appreciation does not give you money every month. It only gives you money when you sell. So if you're borrowing against the share value, the gains, there are no dividends being distributed. Nothing is paying back the loan. You have to take money that you work for on your 9 to 5 to pay back that loan. Or do like I tell you to do, and put something in there somewhere in your portfolio that is driving dividends, so that the dividends from the portfolio can pay off the loan. Now, the more stuff that is designed to pay you money in your portfolio, the more money coming from your portfolio. The more money coming from your portfolio, the larger the monthly payments are to pay off that loan. If you have 100 grand in your brokerage account, and your brokerage account is putting off $10,000 or $20,000 a year worth of dividends, which is starting to get more than $1,000 or $2,000 a month worth of income coming in from that brokerage account. If you have a car payment that's $500 a month, the brokerage account covers that. But if you borrowed $20,000 or $30,000 or $50,000 to buy you a brand new car cash up front, and now you have a monthly installment that you want to pay on the money that you borrowed of $500 or $700 a month, the brokerage account is covering that, which means that you yourself do not have to go to work to get the money to pay off the loan, because the brokerage account is doing it for you. You yourself do not have to rob Peter to pay Paul, ask your mom and daddy, go talk to your husband or your wife, borrow some money from your kids. You have to do nothing, because the brokerage account is making the money for you. And if you are doing this wisely, where the brokerage account covers your base standard of living and the purchase you're about to make, then you don't have to work at all. This is true retirement, and your brokerage account pays for your spending habits and covers your basic bills. This is how the wealthy live, right? But those people who are less knowledgeable, overly egotized, will run out there and say, my stock went up. Yeah, but how much did you get from it going up? They don't think that. They think that when it went up, they got X number of dollars. No, when it went up, the value of it went up. You didn't get shit. If you sell it while it's high, then you got something, right? You won't be cutting even. You sure won't if you don't. Steven said, I thought about the card that gives you stock back, but decided against it. If I put money there, it stays. Okay, Steven, about that card, I don't like that card. And the reason why I don't like that card is because when you use the card, you're using your money to make a transaction. And then when you use that stock back card, it doesn't give you stock. It buys stock based off of the company that you bought something from, which is coming from the mentality of invest in the companies that you spend money with. Now, what I don't like about it is, one, it's going to use your money to buy the stock. They're not going to give you the stock. And then two, trading fees are going to come from that card, which is different from the normal portfolio of buy and sell as much as you want, unlimited for the membership. So that stock back card does not cover unlimited purchases and sales of the stock through the Stash app, which is a financial fail in my observation, because if you're going to charge me per transaction and then take money out of my account per stock for each transaction that I buy, if I spend $100, you might take out 110 and charge me 5 because of the terms and conditions of this card. And I'm like, nah, fuck all that bullshit. I will stick to directly putting, like you said, Steve, stick to directly putting my money in there, leaving it in there, and then getting the dividends back. And I'll do one of two things. I'll put less money on the profile and reinvest the money from the dividends, or I'll just start withdrawing money from the dividend distribution and dropping it straight into my bank account and paying bills. But at no point in time am I going to use that card where they're going to charge me extra money to use the card. Yeah, I'm going to get more stocks in more places where I spend my money, gas stations, grocery stores. I would have a shit ton of Walmart stock. But fuck all that. Michael says, it's best to have your fingers in as many lies or pies as you can. As many pies. Yep. You want to love me some pie. The risk values. Yep, we got to deal with that. High risks when you're young, low risk when you retire. Well, really, once you get old, once you reach a certain age, you shouldn't have to deal with the risk. You should be benefiting from your past risk. So you're right, it should be at least low risk, if not no risk. So if you're riding a brokerage account, or you're living off of a retirement fund, a 401k, Roth IRA, whatever the case may be, when you reach 60, 70, 80 years old, and you start really living off of your investment, especially if you have an 80 or 100% dividend return on your portfolio, not 100% of your investment, like dollar for dollar, but I mean like 100% of the shares that you bought are dividend paying stocks. Then you have a steady income, and that steady income is something that you can live off of. And if that steady income is enough for you to live off of, you don't have to borrow against the principal. You don't have to worry about the volatility of what if the stock market goes down, they might have to sell some of my shares, blah, 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 blah. You don't have to worry about all of that. You can live life inside of the guaranteed monthly income. If it's giving you $5,000 a month and you decide to go to the Philippines where you only needed $2,000 a month, you're living off of $5,000 a month, you can take care of 2 families with that kind of money. You have 2 wives in the Philippines because you're taking care of 2 families with that kind of money, right? And the women in the Philippines will work together to take care of you because you're taking care of everybody, right? So the thing is that since you don't need for nothing, you don't have to borrow extra money that you don't need. But if you were living in America and you were getting that $5,000 a month, you would just have to put yourself in the city and state that money goes far enough where you don't need for anything. So if you have if $5,000 a month might work in Florida, it's not going to work in California. It might work in some of the cheaper areas of New York and the Bronx, but it would do very good in like Mississippi, Alabama, Louisiana, Kentucky, Connecticut, Tennessee, Arkansas, North and South Dakota, Wyoming. You know what I mean? So there's at least 25 states in the center of the United States that would benefit from a $5,000 a month income from your brokerage account, right? He said, can you use the EBT card for stocks? No. EBT cards are supposed to be exclusively used for food, and it technically is supposed to be exclusively used for food for you, not for your family, not for your friends. You're not supposed to sell them 2-for-1 to get cash. All of the stuff that people do with the EBT card, they're not supposed to do. He said, you still want to play the game after you graduate from life. He's like, I can't wait to see you from the Philippines. You already know I'm going to the Philippines, bro. You already when I go live from you're gonna see two things because I'm gonna go live from the Philippines and you're gonna see Filipino women walking behind me, bringing me something to drink, bringing me I'm gonna be sitting over there talking to y'all and eating at the same time. You already know. I'm gonna be a happy son of a bitch. Special shout out to FX Trader. He said only 3.2% of Americans reach 1 million in retirement. The rest do not listen to Xander. Well, you are right because they got a lot of people who come here and they try to criticize the fact that I'm relaying this information. They attack the messenger. I mean, yeah, there's nothing I can do about that. They don't want to listen to the information, and then they'll devalue me as a person to debunk the facts that I'm providing. But the people who I'm talking to, the people who are listening to me, can literally research what I'm saying. Like, yeah, fuck, this is literally what he said is literally what's going on right now. And the trends that are happening are actually happening the way he said that those trends are happening. And if we start moving in certain patterns, the way he's recommending that we shift and pivot, we're gonna see some positive results. Depending on how fast we move and how much we put in certain places depends on what our results are. But we're not going to go in the same direction as Xander and see catastrophic failure. I'm the guy that tells you that you're about to walk into a landmine field, and if you don't swing to the left, you're going to have a lot of problems. Some people are going to not listen to what I'm saying, and they're going to walk through that landmine field like, who the fuck are you to tell me what to do? And then after they blow off an arm or a leg, then help me, come and get me out of this, bro. I don't save people who don't listen. And the Lord said he helps those who help themselves like footprints in the sand. I carried you the direction that you were supposed to go until you were capable of walking on your own. But when you look back, all you see is your footprints, not mine. Because your motivation got you there, but that's because you followed my lead. Put some scripture on this podcast right now. Under the palm tree. Bro, I don't know if I'm going to be under a palm tree. I'm not going to count. I'm seeing some pictures of the Philippines, bro. I ain't got no beef with no palm tree. But I can tell you right now, at least once or twice while I'm there, I can see myself at the top of that damn palm tree falling out of that son of a bitch talking about some coconut. Got the coconut. I got my back when I didn't bust my ass. A lot of people that are dealing with capital depreciation, these people are playing a game measured in the red and green numbers on their screen. Green when the stock market is when the share value is up, and red when the share value is down, right? A game that is dictated by market sentiment, world event, and trading algorithms that you have absolutely no control over. And one of the funniest parts about that is that I'm not red green colorblind, but I damn sure act like it when I play in the stock market because that shit don't bother me. Because this obsession with price, which is the price of the stock itself, creates a condition that I call income blindness, right? He says, Have your parents on FaceTime yelling, "Get out the palm tree." Nah, man, he ain't gonna be on FaceTime. My parents is gonna be there with me. I ain't. This is one of the end goals of retirement. My ancestors, my folks, should be able to leave the United States once before they die and experience retirement in a whole nother country, especially a country that has mutual respect and respect towards your elders, which is one of the reasons why Asia is one of the better places to go. There's so many countries around the world that are fantastic. Belize, Belarus, Kazakhstan. There's so many, but when you start going to Belize, Belarus, and Kazakhstan, you start getting really close to Iran, and you don't want to be there right now. But you know, you got to think about uh, Eastern cultures that strategically teach their youth to respect their elders. I've got elders that are like over the age of 65, over the age of 70. And that means that if those elders go to this culture will treat those elders like kings and queens, right? So the goal is to get their old ass out there and let them see what it feels like to be respected in a different country. Because in this country, they grew up in an area where whips and chains was not bondage. Because back in 1950s, y'all already know that the South in America was not good to everybody. Right? So if I was to go to the Philippines, I wouldn't be FaceTiming family members. I'm going to the Philippines. The family members I value would be in the Philippines with me. And I'd be like, see, I told you should have listened to me. Now, some of the main ones that would get to go will be the ones that invested in me. Those would be the ones that say, hey, take my money and do what you said, do with it. That way we can go together. Now the other ones like, I got this, I know what the fuck I'm doing. All right. And then when we're in 3 or 4 different countries, we're gonna FaceTime the family members that didn't listen, like, look at where we are. Oh, I wish I could go. You could have had you shut the fuck up and listen. FX Trader says the national debt will be monetized. And if people do not keep up with the inflation rate, they will be broke. I'm glad you said that, Trader. So I've seen it earlier today, and I'm going to be factoring it into the show in the next few weeks. I was actually going to be doing a 2-part special covering the fact that the national debt is getting out of control and will become a problem that will start outpacing inflation and taxation. So I'm glad that you actually mentioned that. It is true to life an issue, the national debt, and it is going to be outpacing inflation. And depending upon the interest rates of how they sell the national debt to the investors will determine whether or not you can turn a profit off of monetizing the national debt. But the United States is going to monetize the national debt because they're going to sell the debt off to whoever can put their money down on it. Now, income blindness, which is what we were talking about a moment ago. This is going to be when you're so fixated on a stock's price that you ignore the main reason a company even exists, which is to generate cash. And more importantly for us, to share that cash with its owners, the shareholders. So you see a stock's price is just an opinion, right? It's not going to stay the same. It's not a fact. It's the collective, often irrational guess of millions of people about what a company might be worth in the future. That's what its price is today. That's why when you say that they cook chaos into the price, what they're saying is that the share value of this stock right now is taking into consideration certain big money moves or financial catastrophic issues that they may experience in the future. But a dividend is cold hard cash. It's a fact. It is not debatable outside of when they slash the prices. It is a deposit into your account that you can use to pay your bills, reinvest, or live on. It is real. The typical investor waits. They don't do it right now. They wait and wait and wait. And they wait for the market to recover from bullshit. They wait for stocks to break out. They wait for the next earnings report. They are in a constant state of waiting for something else to happen before they take action on something. This passivity is a wealth killer because while they're waiting, their portfolio is just sitting there, getting tossed around by the market's whim. They might have $1 million in assets, but they can't spend any of it without selling a piece of their portfolio, basically butchering the cow that they hope to get the milk from. A portfolio that doesn't purchase cash or doesn't produce cash flow. A portfolio that doesn't produce cash flow isn't really an asset, it's a speculation. It's a hope. The solution is to build a portfolio that acts like a business with a predictable revenue. He said, once you hit six-figure dividends, it will be lovely. Oh, you know how much recklessness I'm going to be doing with six-figure. I'm going to be doing big boy investments with six-figure dividends coming into me. I'm talking about like 5 or 6 zeros on the back of that number. And when we start talking about six-figure monthly dividend distributions, which is like 7 and 8 figure annuals. Just to get 5-figure monthly distributions. When we start talking about like $10,000 a month, like $120,000 a year dividend distribution. If I have the physical capabilities of living a life under $20,000 a year, that means I have $100,000 extra to do shit with every year, which stands for a lot because 50 grand can be reinvested into the brokerage account to offset inflation. 30 grand can go to taxation. 20 grand or 20 grand could be living in another country. You know, there's a lot of stuff that can be done with that. He said the United States has to pay $1 trillion a year in interest payments every year. It is becoming unsustainable. That is what we're going to be talking about. Because you understand that just like Social Security, disability, just like retirement, there is more people putting into the pot that are entitled to a return than there are people getting money out of the pot. And the hope is that the people putting into the pot die out so that they don't got to pay people back. But the problem is that people are living to 90 years old, so they're looking for their money back for 30 years, and you ain't got it. $30 trillion in debt with 1 trillion. Well, they're more than $30 trillion in debt right now, but over $30 trillion in debt, plus an extra $1 trillion in interest payments that they got to give to everybody. Sheesh. Camilla Harris would have gave everybody $1 million and said, kick rocks. $1.3 million. You give me that transaction one time, bro. One time. I don't care what happens to your budget. I know where I'm putting my money. Now, hold on a second. He said, is that another taxation without real representation? There was going to be absolutely no representation on that. And I believe that was supposed to be tax-free money because it was supposed to be a reimbursement for past experiences. And being slid that $1 million or $1.3 million for the average individual who would have had benefits coming to them from certain locations would have got cut off of those benefits. So they would have had to spend that money wisely because that's all they would have had until they died. Because you're not going to be able to get put back on benefits. You get slid $1 million check, Social Security, disability, gonna be like, nah, fuck you. And God forbid they don't be, oh, you got to pay me back for all these years that we gave you some money. There's some issues that could have happened from receiving that $1 million. You know what I mean? But it came in and I would have had my hands on it. I would have put it in places where I would not have to worry about that money going anywhere else. Anybody want a chunk of it If the IRS want a chunk of it, Social Security, Disability want a chunk of it, I'll make some monthly payments out the dividends. But I ain't giving you the principal. I'm keeping the principal. That's what I tell the college students. Take student loans out, subsidized and unsubsidized loans, at the low variable rate that they're offering you. Put it into a brokerage account that is putting out dividends higher than the interest rates of the student loans. Then the difference between what you owe the loan versus what you make off the brokerage account, that's your profit. So if your student loans are 4 to 7% interest and your brokerage account is 14% interest minus 3% for taxation, you're making 11% after taxes on your brokerage account, which is still 4% more than what you owe the loan company, which means that you can pay the loan company back in full and still have a 3% profit off of your total amount borrowed, or just pay supplemental installments to them. And until they change the tax laws, every time you give them money on the student loans, you get a tax deduction on the brokerage taxation that you would have had. So out of the 3% taxation that they would have taxed you, you might not get taxed if you take what 40% and put it towards your student loans. So it's just free money because you would have had 50%, 60% of the money that you got on your brokerage account, you get to keep with no taxation because you put 40% on your student loans. He said, if I touch $1 million, I will never work again at a 9 to 5. I'm gonna tell you right now, if you put the money in the right spot, depending on your standard of living, you don't need $1 million. $500,000 will get you there. Half of 500,000 will get you there. 80,000, depending on what you need to pay for. Because matter of fact, S&P 500 puts out 10% return on average. 10% of 80,000 would be 8,000. Not enough. Now, when you look at, say, 300,000, that's 30,000 a year. Depending on what state you live in, not enough. In your state, Stephen, 30,000 a year would be enough. 35, 40,000 a year would be enough. For 50,000 a year would be $500,000. But when we start talking about what we're doing with the brokerage account right now, roughly about 15% return on investment on average, that 40,000 would be giving you like 15,000 off of every 10,000, and you start looking at like 60 grand. Or no, 1,500, which would be like 6 grand, which is upward of 400,000. That'd be like 60 grand. So you'd be getting 60 grand off of 400,000, and 60 grand a year off of 400,000 in a state that requires you to, if you're living reasonably, only require like 30 or 40,000 a year, where the median average is 68,000. You should have 20 or 30 grand extra that you don't need, which means that you can reinvest that back into the brokerage account, take a percentage of it, and travel with, and you would only have like $400,000 in the bank. You don't need to be a millionaire to quit working. You just need to live responsibly off of the money you're getting off your brokerage account after taxes in order to not have to work again. But yeah, definitely, if $1 million crosses my path, they'd be like, fuck, I'm done. I'm done with a lot of shit that I dedicate myself to. He said the college loans are another racket that is coming to an end soon. The college loans are capped at $200,000. That's not coming to an end soon. It is already here, because effective June 1st was supposed to be the deadlock, if I remember correctly. That if you don't get whatever you are going to get from the old system before June 1st, come July, you're capped out at $200,000. So if you already got $200,000 worth of student loans, you're not getting more than $200,000 in a lifetime. But for those students that are just starting out, for them ratchet kids that was dancing in the streets with their mama's Social Security money, the boy that got shot and killed with that wad of cash, going to prom, showing out, them kids, they go to college and take their money, and over the course of their college education, borrow 200 grand, capped out at 200 grand, and they put that 200 grand into a brokerage account, and that 200 grand brokerage account is giving them 15% return, but they owe the lenders 7% on that 200 grand. You're, after taxes, still making 4% return on that 200 grand that you don't have to give to anybody. That's your money. And 4% of 200 grand, that's what, 4,000 off every 100,000. So that's like what, 40, 80, well, no, four to eight, almost $10,000 a year off your brokerage account, roughly. I'm just kind of crunching numbers in my head that you would get off that's your profit. After you borrow somebody else's money to make yourself successful, you would still be walking away with almost $10,000 a year off of somebody else's money. You can still pay that guy back. Because a total brokerage account would have been giving you like twenty to $30,000 a year, but you'd be taking like 10 or 15,000 out of that and giving it back to the student loan. But you'll be keeping 10,000 a year. And since you're giving it to the student loan and it's still a tax deduction, you're not going to be paying taxes on the money that you made that went to the loan, which ultimately gives you that $10,000 free of charge, where you didn't put any effort into going to work to get that money. You went to school. That's called a career student. You went to school. You kept your grades up. They kept fronting you money, and you kept investing the money that they fronted you. And now you've got more money coming in than they're asking you to give back, which means once you give them what they asked for this month, you keep the difference. So why they can't? He said 15% rate of return is insane. What are you doing again? Investing in brokerage accounts. So Stephen will tell you, bro, I didn't already put in the membership. I put like 3 or 4 different types of portfolios, where right now we have real estate investment trusts that are doing 20% returns. We got like 3 or 4 of them right now that are doing 20 and 21% return on investment. Then we have tech stocks. We have certain growth stocks involved. We have BCs. We have the oil companies. So we have Shell, Chevron, Exxon Mobil. Let me show you some of these stocks right here going across the top of the screen. Some of the ones that we holding right now. Shell, Chevron, Exxon Mobil, DHT Holdings, International Seaway. I told you guys about Ontario Group, that is the tobacco company. Realty Income. So a lot of different places where we're drawing back on average about 15% return on investment. And the only reason why it's an average of 15% return on investment is because the oil stocks that I tell you guys about are like 3%. Johnson & Johnson that we got in there is like 3 or 4%. You know, that brings the average down, but the average is around about 15% interest. And if you want your interest rates to be slightly higher, you put more money on the real estate investment trust and then rebalance the dividends into the other stocks. You're still going to get a shit ton of money off of this portfolio, which is outpacing the S&P 500 in catastrophic trading environments. It is far outpacing the S&P 500. And I got this information in the membership. So for $3 a month, you're like, shit, I didn't even know these stocks existed. And I give you the strategy on where to put it, what percentage of your money you put into each one of them. So, and then I did the calculations on how it would look after taxes, so that you can see your monthly returns on it after you put up a certain quantity of money. I wasn't playing when I put this stuff together. So when I'm talking to you guys about this, damn, look at me glitching. So when I'm talking to you guys about this stuff, and today we're going about some different stocks today that we're going to be going into for June and July. But when I talk to you guys about this stuff, I talk to you guys about this stuff because yes, you can outpace the S&P 500, and you can have 15% return on investment with like 17 or 18 stocks. You don't need 1,000 stocks. Anything over 20, you're no longer dealing with volatile market. You flatten out the risk factor of your portfolio, and now you're just chipping away at your interest rates. You know, when you start doing, once you start creeping over 15, because if you got 15 really good ones, the volatility has been ironed out, and then you start lowering your interest rates. But when you start doing like 17, 18, 19, 20, the all you're doing now is just further ironing out your interest rates because the volatility is gone. But I grab from different markets. I got health, I got staple, consumer staples, I've got oils and everything to that effect in that portfolio. Oracle's in there, which is TikTok. I got all kinds of stuff in there. It's like, bro, if you grab these, and these are all dividend paying stocks, if you grab these, all of your stocks are paying dividends. And then whatever you decide to do with that portfolio, if you leverage it for capital, it gives you back money. All you got to do is make sure that the monthly payment they expect you to pay back is less than the dividend return that they're going to give you. And you can start buying shit cash up front based off of whatever it is that you got going on in your portfolio. So he said, what are you doing again? Here, I'm on the show telling y'all how to make, save, and invest money. And that's what tonight's show is all about. He said, I'm just going to kick back at my dad's stack for a few years. When I graduate college with no debt, I'll be set. That's the best way to go, bro. Now that Gavin in over on CA is beefing with Chevron. Ooh, I'll buy more with the dips. Ooh, make sure that you put your money on Chevron though. When the stock drops, put your money on Chevron. You can put your money on Gavin, but Shell, Chevron, Exxon Mobil are the three because Chevron is in Venezuela. So you really want to put your money on Chevron. Exxon Mobil is another one that you want to put into because I think either Exxon Mobil or Shell is an international company. So you're starting to get benefits from like Europe and shit like that. So you want to get Shell, Chevron, and Exxon Mobil, right? I know when we look at ExxonMobil, we think a Middle Eastern guy like the Quickie Mart. Hey, how can I help you today? You know, hurry up and buy. You know, I know that's what you're thinking, but them companies are coming from overseas. Those stocks are more stable. But Chevron is already in Venezuela. So when you start talking about the profits that come from drilling the oil in Venezuela, and then when you start talking about the profits that's going to come from what they're doing in Iran, you want to have Shell, Chevron, and ExxonMobil. But you also want to have DHT Holdings because those are the shipping containers that are shipping the oil all over the place. And International Seaway because those are shipping companies that are shipping the oil all over the place. So when we start talking about stuff in this show, bro, we talking about how you can stop trying, you can stop stressing, you can stop worrying and be like, shit, like if I would have knew this 10 years ago, I wouldn't need nothing today. He said California's governor is at war with Chevron. Can't wait for the dip if it happens. Oh no, the dip is going to happen. Okay, so Chevron is not going to the Chevron stock is going to dip because of conflicts with the ability to get oil to America. Chevron's availability is going to dip because of the governor being an asshole in California. Now, the loss of consumer base will cause the stock to dip. So there's not an if. It will go down, but it will not stay down. Billionaire buddy of Warren Buffett claimed that he never diversified beyond 3 stocks, and he made a fortune beating S&P 500 by a lot. It's possible. If I was to buy the 3 that I'm looking at, the 3 real estate investment trusts that are all knocking out over 20% return right now, and I just max out those and just continue to buy into those, that over the course of 20 or 30 years, as long as those companies don't slash their dividends, I'm in a position where while the share value is not going to get massive, I'm not going to go from $2 to $10 a share on these stocks up to like $30 or $40 a share or $200 or $300 a share, because their goal is to give 90% of their profits back to their customers. But I would be seeing a massive cash-driven engine where I'm going to hold a significant quantity of dividends and have a significant quantity of shares and have a significant quantity of dividends being given back to me. But the thing is that if you're afraid that and this is what diversification is about, you being afraid of what if this shit goes south? What if one of those real estate investment trusts goes under? What if too many people aren't paying for rent and not enough stuff is being sold and some of those real estate investment trusts goes under? If all of my money is in one of those companies and that whole company goes under, which is highly unlikely in our current market, but if it were to happen, then all of the money that is involved with that company will be gone too, right? Because they're not going to give you your money back if they go bankrupt. Okay, so that is why people diversify these days. But if you're willing to, if this is a surefire thing and you're willing to bet against the thing, then you can put your money on some of the most volatile stocks, outpacing the S&P 500, not diversify at all, hold three really good stocks, Prospect Capital, Orchid Island, and Ellington Residential. And those 3 stocks that are well over 20% return right now would be fantastic to marinate on as far as dividend distribution. And if you're going to hold on to that for 20, 30, 40 years, you would potentially be riding 18 to 20% return for 20 years. And that type of results would give you a massive quantity of payout over a shorter period of time. Yeah, you're paying full taxation on that shit, because they don't pay taxes. They offset the taxes onto their shareholders. So the shareholders pay the taxes. So out of your 20% return, you're going to be seeing 3% of taxation come out of that, which means you only have 17% profit off of it. But then when you start looking at diversifying it into some of the other stocks, because Donald Trump put up the laws in 2025 that changed certain stocks where the company pays taxes before they distribute the shares to the shareholders, those companies qualify for deferred taxation. Those are going to be the shares where if you buy and hold the shares, you don't pay taxes on some of the value of that stock, whether it's the dividend distribution or the growth of that stock. Now, you having to pay less taxes to the government is the reason why I got 17 of them, because probably 5 or 10 of them are not going to get taxed, you know. But if it was all about making a shit ton of money, oh yeah, I could just all in on 3 different companies that are all doing the same thing right now, 20% return on each one of them, and just turn over a massive quantity of profits and just give that taxation to the United States government and be like, fuck it. Or put it somewhere, pay off some debt, donate something somewhere, and still not have to pay the taxation. But the objective is that if I want to turn the money into a stable income stream that has little to no taxation, and then still have a massive dividend driver, I'm taking a financial loss on the risk by doing less risky trading and then doing less taxation and less dividend distribution. So instead of me getting 20 off the pace, paying 3% sitting on 17, I'm getting 15 off the pace and likely going to end up with 12 or 13, but I get the benefit from growth that's untaxed. So it's sacrificing one thing for another, but then I have consumer staples and other such stocks that are guaranteed to grow in value. Now, what I would be sacrificing in my monthly installments, my monthly returns, whatever, would be the principal observation that down the line, I can say, well, this whole portfolio ain't going nowhere but up. Let me borrow a massive quantity of money, make a big purchase cash up front, and then use these dividends and pay back that loan. Which, if I was going directly in a real estate investment trust, the volatility of that particular situation at like some of these are like $2 to $3 a share, some of them are $9 and $10 a share, which are very, very cheap. Like Stephen is talking about, there isn't much room there. So if I had those types of stocks, I would probably have to get closer to 30 or 40% return when I borrow against a stone, just to make sure that if it went down, that it didn't go down by half and take away all of my money, which will put me in a position to say, well, out of $1 million, I'd only have to get 300,000. Out of 100,000, I'd only be able to get 30,000. Still enough to get me a Honda Civic or a Toyota Supra or something like that. But it's not the same as being able to say, out of 500,000, let me get 250 and go and buy this house cash up front and start a real estate investment business where I can start making money off of rent. So I'm sacrificing the dividend return for growth so that I can use that growth for something else. Right? It's a sacrifice that you make. It's less volatile, but there's a lot more involved with your ability to, because you're planning for the future. But if you stay in pure volatility, yeah, the same way Warren Buffett stayed with Coca-Cola and made himself a multimillionaire, I could stay with real estate investment trust, and assuming that those real estate investment trusts don't go out of business over the next 20 years, I could have some of the highest return rates over the next 20 years. And we, like I said, 18 to 20% return on investment for 20 years, I would be hitting a millionaire inside of 10 years instead of 20 years. And I would be a multi-millionaire, $2-3 million, $5 million in 20 years. And at 40 right now, by the time I'm 65, I would have as much money as MC Hammer. Michael says 500,000 in assets and several cash flows, but can't do it if you have debt. That's right, because as long as you owe somebody, you got to get that money back. Is that so they tax the dividends that were distributed each year, but not dividends that were not distributed? No, that's the thing. Real estate investment trusts don't pay taxes on the profits that they give to the shareholders. So those companies are not covered by the new tax laws. The new tax laws take companies that you buy and hold. It's 121 days total, 60 days before the ex-dividend date, the ex-dividend date, 60 days after the ex-dividend date are considered standing still companies or standing still stocks. And those, they have like a deferred or preferred taxation rate, 0 to 22% for up to 34,500 for single filers, 64,700, I think it is, for head of household. And I don't know why nobody does head of household. There's so many people file single instead of filing head of household. If you and anybody that you know are in your house at any point in time during the year where they are benefiting from your financial investments, but you put the most into your household, that makes you have a household. So if you got friends that sleep on a couch, you got girlfriends that sleep in the house, you got kids that sit in there, you got a family member that's living in it, you're a fucking head of household, okay? And that's 64,000 and some change. Now, if you're married, it's 97,000 because it's going to be 150% of being single. Or I think it's 150% of head of household, but it's still like 97,000. It's 97,400. That's non-taxed money, right? So if you're getting 10%, 97,000 if you're married, that's why you get married. Because if we are sharing this brokerage account, I can have $97,000 worth of money at 10%, which is $970,000 that I don't have to pay taxes on because the money's not moving. If I'm in a household, it's $64,000. So I could have at 10%, I could have $64,000 or $640,000. If I was getting almost 15%, it would be closer to like maybe $500,000 that I'd be getting $64,000 a year from, and I wouldn't have to pay taxes on it because certain stocks are not taxed because the money's not moving and the company pays taxes before it pays the shareholders, and those companies are exempt from taxation. Or those shareholders are exempt from taxation from those companies. So I grab companies that qualify for that. And that's why instead of having 20%, we're closer to like 15%. Because a lot of the companies that we have with the stocks that we have are not going to be taxed as much as the real estate investment trust. So I told you it's complex. Didn't MC Hammer end up broke? MC Hammer is worth like $5 or $5.5 million right now. He is considered rich broke because he was above $53 million a year and now he's down to $5 million. So in the life of the wealthy, he is broke. But MC Hammer still has a net value of over $5 million right now. And you can Google that. Right now, MC Hammer has businesses, he has assets, he has stuff. He just doesn't have $53 million worth of stuff. He doesn't have a mansion with gold toilet seats in it anymore. He might have a regular house, a regular car. He might have a two-story house with a luxury car, but he doesn't have a 53-bedroom house with 53 gold toilets in that bitch like he did when the IRS came and took his shit because he owed $800,000 of unpaid taxes and he had the money to pay that shit back. I don't know what kind of friends he had because he was paying folks, he had people like $500,000 a month worth of salary that he was paying each one of the people in his group, getting $5,000 a person so that they would not have to do something wrong after they got out of jail that would cause them to go back to jail. With all the folks that I was sliding money to keep them out of trouble and keep their life together, I should have had $800,000 from my folks. They should have been able to rob Peter to pay Paul, rob Peter, rob Paul, rob Joanne, rob a bank, rob them all, and get me my $800,000 so that I could get so that I could have kept my mansion with my gold toilets. But that's okay. He learned from his mistakes. He's still doing good, but that man ain't got to work. He don't even got a hammer time no more. You know? Michael says, when I sell, I average well over 100% return. Well, that's because you're buying items from the estate sales, and then you sell, you buy very, very valuable, very high quality stuff that people don't know exists, and then you sell it in places where people are willing to pay 100 times, 200 times more than what you bought it for, and it still be cheaper than what they could have gotten it from somewhere else. So you really know how to market your stuff. You buy from garage sales, estate sales, and then you resell it. And the internet is going to be a great place to sell it. Yeah, you're right, and that's true. But see, the only reason why I don't promote this as often is because You have to have the motivation to get up out of bed, go to this transaction, make the sale, collect the property, bring it somewhere, hold it there, market it yourself unless you're paying somebody to do it, sell it online. Somebody's got to box it up, ship it off to somebody else. That is effort. It is residual income from, if you're doing this as a hobby because you're retired and you ain't got nothing else to do, it's fantastic. But for me, I want to be able to roll out of bed, eat, take the dog for a walk, hang out, wander around, maybe do some shopping, relax a little bit, get ready for my podcast, go live, take the dog for a walk a couple more times, maybe watch the sunset, look at the stars, take my ass to bed, and notice that is supposed to be like my daily life. Like there is absolutely no effort involved in making money, make money for me. So while the estate sales and the garage sales and even picking up vehicles from the auction and then selling them on the block is fantastic ways to make money for yourself. The fact is that it takes effort to go out there and get the merchandise. It's going to take effort to advertise the merchandise. Then it's going to take effort to do the transaction to get the merchandise to the buyer so that you can get the profits from the buyer. And then you have to replicate that behavior on a regular basis. And at the level that you're currently doing it at, you're not even scaling it to a magnitude where you can remove yourself from any of those transactions where somebody else is doing all the work for you and you're just getting a percentage because they're using your money to make the transactions. You're not even doing that. And once you get to that level where you say, well, I'm going to teach you how to do this, young man. I'm 70 something years old. I'm going to teach you how to do this. You're going to go, you're going to get these things, but you're going to pay me X number of dollars for using my money, which guarantees me money whether you make a sale or not. Almost like some of these companies that are leasing money to used car dealers where they can go to the auction on somebody else's dollar, buy the cars, and then for like 60, 70, $100 a month, they're gonna pay these people a premium until they give the people their money back. That puts you in a position where you're picking up a car, you're holding the car for 30 to 90 days. They are going to pay you money for holding your money, and then they will pay you back before you give them more money to go and buy something else from the auction. Now, ultimately, you're renting your money to somebody else for profit, peer-to-peer lending. And in that scenario, instead of me going to each auction, picking up cars, waiting for them to sell, fixing the cars, going through all of this stuff, trying to collect the money, blah, 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 I'm going to lend my money to somebody else for them to do it so that they're just going to pay me every month for having my money. Same thing with the estate sales, same thing with the garage sales. Is I'm going to lend it to somebody for them to do it. And then they're going to give me my money back with interest as long as they have my money, right? In all scenarios of the boss mentality, you take yourself out of the manual labor work of things and you put yourself in a position where other people are doing the work for you and you're still getting paid. Now, you're not going to make as much money as you would have made if you'd have been doing everything yourself, but you buy back your time and you buy back your freedom by not having to micromanage every single dollar that comes to you, which is one of the reasons why we're doing today's show, talking to you guys about how to make money for you. It's not just a slogan. It is a way of life where the money is going to work and turning back a profit and you're spending the profit. You are not doing anything. Sipping Mai Tais on a yacht in the Bermuda Triangle is only plausible when you ain't got to clock in to work tomorrow. You know what I mean? That's the stuff that people don't think about. You know, being able to travel the world only happens when you've got more money coming in than you've got money going out. See what I'm saying? And that's not that's what people fail to understand. He says that Venezuela is not affected by the Middle East. Send the oil to California refineries. Well, no, Venezuela is not affected by the Middle East, but the oil that so Chevron is in Venezuela, but Chevron is also going to the shipping containers. So I think this is the part that you're failing to understand, Michael. So here's the dynamic of things. The ships have to change the direction of travel because they can't go through the strait anymore. So that costs more fuel. Then you have um, the shipping, the ships have to pay higher interest rates. If their route has to go past the conflict before it gets to California, before it gets to Venezuela, there's still going to be a premium there. You know, Chevron is impacted by the conflict. Venezuela is not. But California's beef with Chevron may impact Chevron's ability to produce gas in California. It's just like if y'all remember those bird scooters that were banned in certain states because the electric batteries were blowing up and the kids were being reckless with those scooters. A product can be denied by the local government to be sold in that city or state, which then redirects that resource to another city or state. I mean, realistically, instead of getting the oil from Venezuela and doing the refineries, you could just go get the oil from Louisiana and Texas and just drive the shit over to California refineries and save a shit ton of money on not having to ship the oil from Venezuela. But I mean, we're just talking about realistically. That's not what we want to do. That's not what America's government wants to do. It would be lower cost of gas on the West Coast. It'd be lower cost of gas in the South if they would have finished building the wall with a real wall and then layered it with solar panels the way Donald Trump advertised that they were going to do, or mentioned that it might actually occur, then it would have powered the entire South America. And if you had Louisiana drilling oil and sending it to the refineries in California, you not only would have solar power that would be reducing power consumption in America, you would have local fuel from Louisiana and Texas and Alaska that would be so much cheaper than going to Venezuela to get it. But that's not the point. The point is that while we might have over 100 years worth of oil in America, we would have more valuable oil in America when everybody else runs out of oil if we take everybody else's oil and sell it today and reserve our oil for tomorrow. That's the idea. Is that Warren Buffett gets 1.5 cents for every Coke product sold around the world. True, but that required Warren Buffett to get in on Coke before Coke was important. You remind me of a house like Michael Jordan's that took 13 years to sell for $9.5 million. That's what I'm trying to tell you. The original price was $29 million. He had the money to wait. That's what I'm trying to tell you. I'm not trying to wait for that shit. I'm not trying to put myself in a position where I'm holding some shit for 13 years so that I could sell something and make less money after it's sold than what I would have made if I would have just been getting paid to have it the whole time. If I had a $9.5 million house and somebody was giving me $1 million a year to sit in that bitch, I would have got $10 million back over the course of, well, I would have got $13 million back over the course of 13 years because they would have been giving me $1 million a year to sit in the house. And I still would have the $9.5 million house, which I could leverage from $4.5 million and use that for something else, which actually now, instead of me getting $13 million, I would have had like $17 million, $17.5 million, right? Which I could have used to go and buy 2 more $9 million houses in that 13-year period where I would not have to. And you talking about the original sale price of that house was $29 million. That motherfucker took a $16 million loss. Some people don't do smart things. Ship insurance has gone way up. Yeah, and that's the reason why Shell and Chevron, because it's going to be the total usage of the ship because the ship has to go to certain places. It's not just, oh, well, we don't have to pay that insurance because we're going to Venezuela. No, if you have car insurance and your car insurance is high because, say, the state of Florida has high crash rates and your vehicle is registered in Florida, doesn't matter if you're driving a car in Tennessee. What matters is that as long as the car is registered in a location where there's a high quantity of crashes, your ass is going to be paying high ass insurance. So if the boat has to pass through India, if it's going to China, if it's going to stop by Russia, It's in the area where conflict is, which ultimately means that the insurance is going to be high. So once they get to Venezuela, even if they go directly from America to Venezuela back to America, because they're still at some point during that month still going to go to Japan, the premiums are going to be high as fuck. And because the premiums are high as fuck for the usage of the ship, not for the individual trip, the cost of gas is going to be high all the way around. He said, Berkshire Hathaway Company owns 9.3% of Coke. That's because they were smart to get in there after Warren Buffett. I wonder what will happen to the Tiger King's house now he is being bars. He's behind bars. Oh, they're gonna sell his house. If he okay, so I don't know what he went to jail for, but if he went to jail for any type of monetary gains from illegal activity, his house is gonna be sold undervalued, and then he's not gonna get those profits off of it, but the government's gonna get the profits. Now, if he's in prison and his house was quote unquote owned, then and he's not in prison for profiting off of violent crime, then his house would likely be used by his family, and somebody was going to be trying to pay taxes on that bitch, and or otherwise it'll sit there empty until it is seized by the government and then sold off for back taxes. So that's like the three options. The 2 out of 3 options is that they're going to sell it. One option is that if there is no lien against it for legal action of any kind, then the house would end up going to his family. Whoever knows that the house is there and has the keys to the house, who can use that house. I guess he did not have a creative real estate agent like yourself. No, he didn't. So Michael Jordan was a very fantastic basketball player. He was a very decent manager. He did okay with certain other sports that he put himself into. And I think he might even call himself trying to go into music. He did a good job with marketing shoe deals with Nike and other such things like basketball jerseys and other such stuff. But nobody knows everything about everything. He had the money to spend. When he bought the house, he probably bought the house thinking that the house was a good house to have. Then, after the market crashed, he still had the house, and then he decided he was going to sell the house, and he waited until somebody bought it. A lot of multimillionaires buy real estate because they have money. Just like Drake had bought that $448 million house before a lot of his credibility left with that Kendrick Lamar song. He's got the house. It's his house. Now, is that house worth $448 million? With like 23 sex offenders registered to that address? No. The fact is, though, is that he bought it at $448 million because he had access to $448 million worth of assets. Now, if he decides to sell that house, it might be worth half of what he bought it for. One of the reasons why when I tell you guys about going into real estate, fix and flipping houses is not a good look for the average person, because the effort of getting the house on a good deal, putting a lot of money into the house to fix it up, and then selling it for more than what you bought it for is too much of a hassle. If you're going to go into real estate, you have to do a buy and hold and turn it into a rental property. So had Michael Jordan, instead of doing a flip and selling the house after he bought it at $29 million, he should have bought it at $29 million. And especially if he bought it cash up front at $29 million, he could have leveraged it for 65% of its value, where he probably would have taken out a mortgage on a house for upward of like maybe 13 or $17 million, $18 million, take like 60% of the money back off of buying a house, and then rented that house out for like $1 or $2 million a year for some rich people who would have loved to live in that house. And because the money that he's getting off of the rent is less than the money that the mortgages cost, he's not going to get taxed on that money. Now, he would have been doing that, buy and hold on that $29 million house. He could have pocketed $15 million off the top, $15 or $18 million off the top, and bought another house far cheaper than the first house, and turn that into a rental property as well, and get paid from the tenant that's living in the house. And at the end of the day, he would have had a better result than that $9 million, because over the course of 13 years, that $29 million house would have only needed to make another $13 million after he borrowed the $13 or $14 million to cover the spread on the total value of the house, and the tenant is still paying for the house. He didn't think about that when he got rid of it. Nobody taught him that. He comes from my generation and before my generation where we weren't taught how to be financially savvy. We learned how to be financially savvy by making mistakes like that. Now that we know and knowing is half the battle, now I come on the show and I tell y'all, let's not do it like that because that's not beneficial. A lot of the retirement stories that we talk about, it is about buying a bunch of shit. And then once you reach a certain age, you start selling it off and living off of the profits off of you selling it off. And I keep telling y'all, wow, that is a fantastic model to buy $1 million worth of stocks and then start selling it off at 70 years old. I keep telling y'all can get $500,000 worth of stocks and just live off the fucking dividends. Y'all can get $250,000 stocks, depending on how cheap your lifestyle is, and just live off the fucking dividends and never sell shit. Will the shit to your kids, your grandkids, right? They're not teaching that. This isn't stuff that happens in school. We don't talk about this in school, you know? So we never knew this. People who went to college and got degrees did not take one class on financial responsibility and did not take one class in investing. Even the accounting class was about calculus. It wasn't about brokerage accounts and investment opportunities. So we never learn this stuff. We get out of college, stumble across some guru that's making you pay for a seminar. Some of them offer the free seminar and feed you a little bullshit, and then they convince you to pay for an extended seminar where they're going to feed you a little bit more bullshit. Then you're going to have to do research on it because they're never going to tell you exactly what you need to be successful, but they're going to keep baiting you in with little tidbits of information that keeps you locked in. And then they're profiting off the fact that you're locked in without ever giving you the keys to the fucking kingdom of success. I'm over here throwing fucking keys around like, bro, if you take this key and go to that door, it will fucking unlock. And a lot of people are stepping over those keys and walking past the podcast. And eventually they're going to come back and be like, shit, I should have picked that fucking key up because this motherfucker's making money. Trader said, you're all right. He should have Kobe and Shaq living there paying him. That's what I'm trying to told you. Kobe and Shaq could have lived in that house. Kobe could have stayed in that house with his wife until the helicopter crashed. Then Shaq could have stayed in that bitch. Then LeBron James could have moved into that house because since LeBron James is trying to be Michael Jordan so fucking much, LeBron James probably would have paid double to live in Michael Jordan's house. But they never did. They don't think about stuff like that. Rich people buy for the sake of being capable of doing so. The poor-minded rich people buy for the sake of being capable of doing so. And one of the things that you notice is that a large majority of minorities who do not come from generational wealth, the richer they get, the faster they get rich, the more money they spend. And that's why you see them doing all these random commercials. They're doing all of these devaluing and degrading ads and skits and guest star on shows because they need money to pay off their debt. Yeah, they've got millions of dollars worth of assets, but they borrowed against a stone, living the high life, burning the candle at both ends financially. And now they have all of this debt, no more income coming in, and they got to go and do a movie. They got to do a shitty movie. They've got to guest star on a shitty sitcom. They've got a guest star on a radio station. They got to get paid for press conferences and all this other stuff to bring in money to cover the debt that they can't afford to pay. But they have millions of dollars worth of assets that belong to debt. And that's one of the reasons why, even though they're millionaires, they're still broke because their money is tied, their assets, their stuff is tied to debt. So now they got to do shit that their ethics and morals are compromised by, putting on dresses as males to be characters in movies. So you get a laugh on it when you watch the movie, but that goes against their moral compass. But they're doing it for the money so that they can pay for the lifestyle that they've already pre-financed, right? But for the rest of us who know how to live off of the interest of our principal, we don't have to compromise our values in order to make money because we're living beneath the quantity of money that we make. So we cover the spread. And like Steven said, never sell nothing. It's all going to the kids. And it's only going to go to the kids that you like, because there's going to be some kids that you don't like, and you're going to be like, fuck you, you ain't getting shit. And then you lie, because when you pass, they still going to get something. You just wanted them to feel some kind of way while you was mad. You're out of the will. You know. Trader says the rich and the poor have to lower the price of the mansion and cannot sit on them for years. Oh yeah, everybody's got to lower the price of the mansion. Everybody, because the mansion is only worth what the other 5 or 10 houses sold in the area in the last 30 to 90 days is fucking worth. So you buy a $29 million mansion when real estate was booming, and then all of the rich people in your area foreclosed on their house because they were part of Bad Boys movie with Will Smith. And in that situation, all the houses in the area dropped to a house because nobody's willing to buy a house in that neighborhood for $29 million no more. All the houses are going for $3 to $5 million. So now your house, one of the higher value houses in that area, is now worth $9 million because nobody's willing to spend $29 million in that neighborhood anymore. The appreciation on paper is how much your house could be sold for in the current market under its current condition. How much your house is worth is what somebody is willing to give you right now for the house today. And if ain't nobody willing to give you $29 million for that house, that motherfucker ain't going for $29 million. Now, when we start using our money and our stocks and our portfolios as a business, the strategy that I'm talking about to lay out is designed to do exactly that. So we're going to build a system that targets a specific, often quiet period in the calendar. And we're talking about the June and July year to create predictable surges of cash, which is going to give you back a sense of control and turn your portfolio into a source of stability, not a source of stress. Now, what exactly is the summer income surge? So let's be crystal clear about this. What this really is, okay? What it isn't. This is not some magical market anomaly or a get rich quick scheme, because I don't fuck around with those. There isn't a secret club of companies that decided that June and July are months to make you wealthy. That would be fucking nonsense. What this is a framework for strategic cash flow planning. It's based on a simple, observable fact, which all of you can see if you were taking a look yourselves. Dividend payments are not spread evenly throughout the year. Due to corporate fiscal calendars, many United States companies pay dividends around the end of each quarter. As a result, payments often cluster in months like March, June, September, and December, which is the last month of quarter one, quarter two, quarter three, and quarter four. Are you following me? Now, this is common knowledge for the experienced dividend investors. If you have a portfolio, even with the real estate investment trusts that are paying you every month, we still have stocks in our portfolio that is paying us once every 3 months. So 1 month out of every quarter, you're getting way more money back than what you got out of the last 2 months, because some stocks are quarterly while there are stocks that are monthly, right? But the June period and the subsequent July payments often exist in a short of news vacuum. It's in that quiet space after the first quarter earnings hype has died down and before the second quarter news cycle spins up. Financial media has less to talk about, and many investors are mentally checked out for summer vacations. It is precisely in this quiet period that a predictable, steady stream of dividends continues to flow. And because fewer people are actively planning for it, it presents an opportunity for those of us who are prepared for it. So to get this, you need to know the difference between 3 key dates. First, the declaration date, which if you guys haven't been following the show, this is going to be when a company announces that it's going to pay dividends. Second is going to be the ex-dividend date. This is going to be the cutoff date. You have to already own the stock before this date to get payment. If you buy the stock on this date, you're not going to get paid. You have to already own it on the ex-dividend date. Third is going to be the payment date. There is a fourth thing, which is the record date, and the record date is usually on the ex-dividend date unless the ex-dividend date occurs on a holiday or a weekend, where the record date is the last business day before the ex-dividend date, right? Now, again, the payment date, this is going to be the day that the cash is actually going to land into your brokerage account. So most people, if they think about dividends at all, focus on the ex-dividend dates. I typically focus on the ex-dividend dates more than anything else, because if I plan on buying into certain stocks, I want to either buy in throughout the month because the stock's steady on a dip and I've got money coming in, or I want to buy in about 5 to 7 days before the ex-dividend date, because usually around a week before the ex-dividend date, you usually see a lot of performance where some stocks go up and then go down, or some stocks go down and then go up. The ones that go down 5 days before the ex-dividend date, you buy in while it's in the negative, it will go back up above what you paid for it. And when it does go down slightly on the ex-dividend date, the value of the dividends that are going to get paid out, it is still more than what you paid in. So you experienced growth in that 5-day period. If you buy the day before the ex-dividend date, you will not have the stock with enough time to experience the volatility fluctuation in order to receive the growth after the ex-dividend date. That's why I tell you guys to try to mess with it about 5 to 7 days before the ex-dividend date. But for our strategy with this one, we're less focused on payment dates, right? Because the money is going to come when the money comes. We're building a cash flow machine, and you measure a machine's output when the final product comes off the line, not when a part is out to order. So we want to know, when do I get paid, not just that I get paid. Trader says, is it true that the stock price drops immediately after the dividends is paid? It is true that the ex-dividend date is the date that the stock market drops. The payout date is not the ex-dividend date. The date that they take the value of the stock dividend out of the price of the stock is the ex-dividend date. So, to answer your question, no, the payment date does not cause the stock to drop. Geopolitical trends causes the stock to drop. The ex-dividend date, when they, so say for example, Prospect Capital pays like 8 cents a share. Or no, Prospect Capital pays 5 cents a share. Ellington Residential pays 8 cents a share. Orchid Island pays 12 cents a share. Now, take these 3 real estate investment trusts. If you bought into the stock at $1, with Orchid Island, it'll go down 12 cents. So it'll be like 88 cents, right? With Ellington Residential, it'll go down 8 cents. So it'll be 92 cents. If it was Prospect Capital, it'll go down 5 cents. So it'll be 95 cents. You would have effectively lost the dividend value of the share of the stock on the ex-dividend date. But let's say you bought into the stock when the stock was 50 cents. The stock went up to $1, and the same thing happened. Yeah, Prospect Capital, you've got 95 cents. You bought in at 50. You made a 45-cent profit. Ellington Residential, you're at 92 cents. You bought in at 50. You have a 42-cent profit. Orchid Island, you bought in at 50 cents. It's down to 88 cents. You've got a 38-cent profit. You still profited per share on your buy. Now, throughout the 30 days of owning the stock, there will be some fluctuations, but there is no statistical data that shows right now that guaranteedly on the payment day that the stock will go down a second time related to the dividends that was already pre-removed from the stock value for this payment period on that day. Does that make sense? So for the June stocks that are paying every quarter, on the ex-dividend day, the stock will go down the dividend value. for the next 90 days, that quarterly stock is not impacted by the loss of the stocks that were taken out or the dividends that were taken out of the stock value on the ex-dividend day. Now, you might find a convenient trend in some stocks that you're paying attention to that it just so happens to fluctuate in a negative direction around about the time that you see a payment in your account. If that is the case, you might want to have your drip set up so that it automatically puts the money back in at the lowest point of the month that you can observe. But a lot of times, the stock will go up. It has nothing to do definitively correlating dividend payments with market fluctuations in between ex-dividend dates. So when we start talking about paying attention to how much we're getting paid and when we're getting paid, you want to think of it this way. A total return investor only cares about the total value of their portfolio. So we're going to be smarter. We're going to be income engineers. We know that in the early summer, certain powerful income sources like monthly paying real estate investment trusts, business development companies or BDCs, and some energy firms reliably keep paying. Our job is to build a portfolio that captures that predictable cash flow. This strategy is about taking back control in a market that you can't control. So in that market, you can still control the structure and the timing of your income stream. First, we're going to take the first step, which is going to be a radical mindset shift, because you have to stop asking what stock is going to go up or go down as a value or a price shift, and start asking which quality companies are going to pay me in June and July. That one change will transform your entire process. Most stock screeners are built to find growth or value in the stock, meaning that the share price, the sell and buy price, continues to go up. They aren't designed for monthly cash flow planning. So we have to roll up our sleeves. That's why I got my polo on today. We have to roll up our sleeves and do a little detective work, which is honestly why this opportunity exists, because a lot of people are fucking lazy. They don't want to do the work. So let's walk through the actual process. You start with the sector known for being income focused. The most obvious candidates are going to be monthly paying real estate investment trust or mortgage real estate investment trust. These companies own properties, and to maintain their tax status, must pay out at least 90% of their taxable income to shareholders, which is why you don't benefit from the tax deduction laws that Donald Trump put together in 2025. Because they're offsetting 90% of their taxable income to a shareholder, which means that the shareholder has gained taxable income. Many of these companies, the ones that I have found, many of them, and I'm putting them on the top of the screen right now. Oh yeah, they're still going across the top of the screen right now. Many of these are paying monthly dividends. He said, I don't have to worry about stock screeners. That's what the membership is for. You goddamn right, because I be screening this shit every single month. I be checking out the waves, the changes. I be talking about the politics. So when you think about it, you come to the show 7 days a week, and 3 days a week, I talk about something that directly impacts your portfolio. Monday, Tuesday, and Wednesday, I talk about something that directly impacts your portfolio. And if somebody asks me a question on Thursday, Friday, or Saturday, or even Sunday that is related to Monday, Tuesday, and Wednesday, I'm again talking about something that directly impacts your portfolio, right? Not too many people pay attention to that, but other places that are like, oh, this stock is doing good, that stock is doing good, growth, 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 trending topics, right? But I'm gonna screen these motherfuckers and tell you, like, you know what? In 15 or 20 years, you're gonna be glad that you still got this motherfucker. How often do you rebalance the portfolio? Well, that depends on what you're trying to accomplish. Now, me personally, I'm putting a larger quantity of my money on the real estate investment trusts that are the most volatile during wartime. And the reason is that when the troops come home, because one of the reasons why the real estate investment trusts are negatively impacted by wartime is because thousands upon thousands of Americans have been relocated to the battlefield, which means that they're not paying rent, which means that the real estate investment trusts are not making as much money on those people, whether the rent is deferred, whether the people have terminated their leases and moved out, or whatever the case may be. The fact is that they're not making as much money off of their tenants as they used to. Real estate has changed because of the new tax laws. So big business is not able to buy those houses as quickly. They're now being forced to develop from the ground up, which is going to take more time, and they have to rent out or sell ground up developments, not purchase pre-constructed homes and then resell them. So real estate investment trusts are going to be impacted by these changes. Since their share values are down, the valuation is going to be really high for our profit margin for the dividend distribution. I'm buying those now so that when the war is over and they creep back down from 20% down to 17 and 18%, I can rebalance back into the other areas of my stock portfolio. How often do I rebalance is going to be at least once a month. But if you rebalance every time you get a dividend, like you get a payment from one of your stock options and then you find another stock to put your money in, you can rebalance. If you got 17 stocks that's paying dividends, you can rebalance 17 times. If you're going to wait till all of your money comes in and then take the collective quantity of money and make a one-time payment on something else in your stock portfolio, you're rebalancing at least once a month. Some people do the drip process where they don't have to do anything. They just put their money up onto the stocks and just let the thing rebalance itself, re-put the money back up itself. Rebalancing is when you're selling shares off of a stock and buying another stock, but rebalancing also when you're using dividends is taking the dividend profits and putting it on the stocks that you have less of. And you're going to put it on the stocks that you have less of that also are cheaper than what they used to be. So when they say underperforming means that the stock went down in value. When the stock went down in value, you buy in or buy back in. If I have a large portfolio of stuff that is down in value because everything is impacted right now, I'm buying back into the ones that has the most benefit for me in the long term. Then when that benefit is no longer feasible or no longer visible, then I will take the dividends and rebalance it to the other parts of the process. So as Stephen told you, in the membership, I actually have a tier system where 55% of the stock is going to be dividend driving stocks, and then the remainder of the stock is broken down into other areas where there's 25% of it for I don't remember off the top of my head, but I know like 20% of it is like tech, and the other 25% of it is like health and consumer staples and stuff to that effect. And the stock is portioned out 12% here, 13%, 5% here of the portfolio that you're supposed to have shares of. So if for some reason that I've got 80% of shares in one location, rebalancing means that I'm going to be over time taking the money that I get off of the portfolio and putting it everywhere else to bring that 80% down and bring up the value of everything else. But at least once a month when you're getting dividends is a good time to rebalance. Twice a month, if you're adding money to the portfolios on separate days than when you're getting dividends back, you're going to want to rebalance twice a month. That's another way to do it. When you're adding money to the principal, if you have the ability to add money to the principal and you're always adding it to the highest volatile stock, and then you're going to take the dividends from that highest volatile stock and put it everywhere else, you're going to be basically rebalancing once or twice a month, to answer your question. Steven says, I asked about Carmen and got an essay back. Oh, he asked about CarMax. He asked me a simple question about CarMax, and I gave him, I think, a 3 to 5 page essay about CarMax. I went into details about CarMax, bro. I went because he asked me, and I thought that was interesting that he actually looked at CarMax and he asked me about CarMax and whether or not CarMax was a good buy to get into. In the long term, 5 years from now, 10 years from now, it might be something good to keep if you're doing a long-term investment situation. But because CarMax is suffering right now, and CarMax is likely to suffer while Donald Trump is still in office, you're looking at CarMax not being beneficial to you over the next 2 to 3 years. Which means that if you're buying CarMax now for the benefit of having CarMax right, that's not a good get. But if you're buying CarMax now for potential benefits of CarMax in 10 years, then yeah, you can get CarMax while it's suffering and hope that CarMax doesn't go out of business over the next 10 years. But you have to understand, when you looked at CarMax, you've got people are poor, and he's asking about CarMax after tax season, where the poor people who used to buy cars just spent all their money on fucking prom. So CarMax didn't get that money. Enterprise got that money. So a really good question was, should I buy a CarMax? Actually, you probably should buy in rental car companies like when you Enterprise, Hearst. Even though Hearst has depreciated its inventory with Tesla putting out robo taxis that is not sold to consumers. They actually created the robo taxi to compete with Uber um, at $30,000 a car, so you can't buy them. You can only rent use them as a customer. But you have like other rental car companies. I can't remember all of them. AVAT, Dollar Car, and all these other places. That if you would have invested in rental car companies before prom, the stocks would have went up on prom, because all jackasses that spent all that money on fucking Bentleys and all this other shit for their kids to look cool for prom, those were all rental cars. So that would have been a good place to get. But yeah, when he asked me about CarMax, I was like, nah, it depends on what you're trying to do with it. You know, I'm never gonna say, but then I also reminded him CarMax is a growth stock. CarMax is not a dividend paying stock. As the share value of CarMax continues to decline, if you buy into CarMax while the share value is declining, you're losing your principal because it is a growth stock. It's not paying you dividends to reimburse you on a loss. During the time that the stock value is down, you're just out your money. If the stock value goes back up above what you bought into it, you can recoup your money if you don't sell while the stock is down, but you're not getting paid for keeping the stock. Again, I tell everybody, for anybody who's not a multimillionaire, for anybody who's not living on generational wealth, if you are living from paycheck to paycheck, it is not beneficial to you to buy into a primarily growth stock situation when you need money on a month-to-month basis. You want to be able to at least say, let me take these dividends from next month's payout and pay this problem, instead of let me sell CarMax short because I need money to pay for my car insurance because I quit my job. You know, these are the differences that helps you with dealing with your risk tolerance. But that information goes into the membership, and not a lot of people get that kind of information. And you do not have, they say, oh, we've got trade advice and trade coaches and blah, 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 blah. Nobody gives you this kind of information. Nobody tells you, well, you know, it depends on what kind of shit you're going through in your life. That really depends on whether or not you should buy that stock yourself. Nobody ever does that. They tell you the value of the stock based on the performance of the market and the fact that they're going to get paid for you making the trade. They're going to encourage you to make the trade. They might discourage you from making one trade and encourage you to make a different trade so that they still get paid for you trading something. I'm just going to tell you, since I'm not getting paid on you trading one way or another, I'm just going to let you know it directly impacts your life if you make that purchase. So ask yourself how much that purchase will benefit you while the stock is down. And if it's not a dividend payer, it's not benefiting you until the stock is up. So if you're playing a long game and you can afford to play the long game, play the long game. But if you can't afford to play the long game, then invest in dividend paying stocks, because the short game will pay you as you progress into the long game, and you will find yourself down the line like, damn, I held this all this time and made X number of thousands of dollars a year plus the growth. That's not something that everybody thinks about, which is what we're going to be talking about today. Trader says the troops have been coming home every week for the past month. No, really. No, the troops have not been coming home every week for the past month. Like as if like, oh, we're not going to war anymore. No, fuck that shit, bro. What may have happened is that certain people's tours have ended and they have come back home and not gone back out yet. Okay, you have to understand the difference between Donald Trump recalling the troops versus the turnover of employment. And when it's time, think about it like this. I know, according to the administration, I know, but we just covered on the show where he was talking about how they had made substantial gains with the discussions in China where they were just repackaging the same shit that they had been doing before. It was a bunch of MOUs, right? Which is like mass levels of IOU contracts, not even like contracts. We're agreeing that we're going to agreeing to talk about doing something that's worth billions of dollars, but we're not actually going to do anything. You're not going to make billions of dollars. I'm not going to make billions of dollars, but the people think that we talked about billions of dollars that's going to change hands and everybody's going to be rich, right? According to the administration, people are supposedly coming home. Well, how the fuck is thousands upon thousands of troops coming home when there's well over 50 to 100,000 troops on the front lines of Iran ready to touch down right now? With, who's coming home? Who's coming home? If they had over 50,000 people out there 3 months ago, and they still got over 50,000 people out there right now, who the fuck came home? People whose tour is ended, they have not gone to conflict yet, and people whose tours have begun, who while we're not in who are not in conflict, it's a changing of the guard. So with the changing of the guard, it's just like if you worked at a Waffle House, night shift clocked in, you've clocked out, everybody on day shifts gone home. That's like the boss saying, I sent home half the shift, half the store, half the crew. No, you did a changing of the fucking guards. It's time for them to clock out. It's time for us to clock in. We're still pushing at max performance. We didn't close down. We didn't reduce the quantity of people on payroll. Everybody still got their part here. But at the end of the day, it sounds like he did. But if you think about it, if all of the aircraft carriers and submarines and think about this real quick. Blockade, 24 hours a day, 7 days a week, blockade of the Iran port. How the fuck are you able? Because that is like a 2-week journey by boat, if not more than that. How the fuck are you able to bring people home every week from the front lines on a 14-day journey while you're mobilizing, as Donald Trump just said over the last 5 days, to maintain the position in case at the drop of a hat, conflict escalates or the negotiations fall apart. As he just said 5 days ago, I was 1 hour away. Now, I don't know about y'all, but I can tell you right now that if my boss was 1 hour away of putting all the employees back to work, do you think I would be headed home right now? No, I would be sitting there getting paid fucking overtime because I'm 1 hour away from having to get back on the floor and start doing my fucking job. So how would all of these people be coming back? And there's still a massive blockade out there where we have not reduced the quantity of ships and subs and aircraft carriers and big ass airplanes and missile silos, all this other shit that's over there, right? And in fact, they're increasing the quantity of shit that's out there, but people coming home. Ain't nobody coming back. Not right now. You got the changing of the guard. That's what you got. That's the most that you're going to see. You have the injured that's going to be coming back, the people who got injured in combat because they can't stay on the battlefield no more. Those are going to be the people that's coming home. The motherfuckers that got shot in the ass, the ones that got their limbs blown off, the one that broke a limb when they fell out of the airplane, when the airplane got blown up. Those are the motherfuckers that's coming home, right? Somebody got shanked when the ship got boarded by some of those little skeeter boats. Those are the people that's going to be coming home. The injured people. The able-bodied people that didn't get hurt in combat, them motherfuckers ain't coming home unless their tour is up. That's the only people that's coming home. because everybody else is on the front line and they're replacing manpower with manpower. That's the reason why there's more ships. And it's going to cost us billions of dollars every month. It's going to cost us billions of dollars every month. Now, one of the other companies that one of the other types of stocks that we talk about is the BDCs, which is business development companies. Now, these firms lend to small and mid-sized businesses like real estate investment trusts. They must distribute most of their taxable income as well, and many of these are going to pay monthly or on regular quarterly schedules that fits our window. Certain energy and shipping companies, these sectors can be huge income generators, but they are more cynical. Their payment schedules vary, so we have to check them one by one every month to make sure that we know what we're looking at. So when I give you guys an update at the end of the month, I have gone through 54 stocks this week so that I can talk to you about it today. Right? All the stocks that y'all see going across the screen, I gone through 54 stocks this week to talk to y'all about it today. And I watch these stocks every month. And I give you a 60-day forecast of my watch list. Now, let's start hunting. Picking a well-known name and going straight to the source. The company's investor relations websites. That's going to be a good place to get all of the information you need for each company that I'm talking about. So let's take Realty Income, ticker O. I'm going to put these up here for y'all so that y'all can go and take a look at these, but y'all going to find that as you write these son bitches down, you're going to find like, oh, them motherfuckers is going across the top of the screen. Like he said that they was going across the top of the screen. They're going across the top of the screen. I ain't bullshit. I told y'all. So it's famously called itself the monthly dividend company, and it is true. If you go to their investor relations page, you find dividends and look at their dividend history. You will see a beautiful, predictable table showing a dividend paid around the 15th of every single month. The company has a track record of over 100 total dividends increases throughout its history. That means that they have gone up in dividend distribution 100 times over the history of this company's existence. This is a prime candidate. We add O to our June and July potential list. June and July, because it's a monthly payer. So let's try another stock. Right? Stag Industrial, ticker STAG. Right? A real estate investment trust focused on industrial warehouses. A quick check of their investor relations site confirms a long history of paying monthly dividends, also around the 15th of the month. So Stag joins the list. Now, for BDCs, Main Street Capital. Y'all gonna see, I'm like, damn, this gonna be doing his fucking homework. Yes, I do. Main Street Capital is often seen as a blue chip in this space. Same process. Go to the website. Find the history of consistent monthly dividends, often supplemented by special dividends as well. Their schedule is highly regular. Main goes on the list. So, right now, we found stable monthly payers. About 4 of them so far. There's more than that, but we've got about 4 of them so far that are stable monthly payers. We have more monthly payers. But our window also includes companies that pay quarterly, with payments just happening to fall in June this time. So to find these, we can use good financial data sites. For example, consider dividend growth lender like, or not dividend growth lender, the dividend growth leader, which is Broadcom. And we actually stumbled across Broadcom because one of the fans came onto the show and started talking to us about Broadcom and Big Bear AI. But Big Bear AI doesn't pay dividends. This is a tech company, not a classic income stock. But If we check its history, we see it has consistently paid a quarterly dividend, with one of those payments often landing in June. Its historical track record shows rapid, often double digits, dividend growth through its wise to remember, or though it's wise to remember that past growth rates aren't guaranteed to continue. So let me say that again. The historical track record shows rapid, often double-digit dividend growth, and even though the past is what it's been doing, it is wise for you to remember that the past growth rates are not guaranteed to continue into the future. But it kind of gives you a hypothesis that if it were to continue, this is likely what you would get. So this gives you potential growth and income component. Now, we have to talk about a cautionary tale. So let's look at one of those cynical, very highly volatile shipping companies like Zim Integrated Shipping. Now, this one did really good in August. It gave like $1.74 a share, and then the next time it was producing, it actually produced like six cents a share, and it wasn't even worth getting in a dividend rotation strategy that month. But in August, it did really good at paying out. So a few years ago, Zim was famous for a mind-boggling dividend yield, but the shipping industry is violently cynical as well. So when freight rates were at historic highs, Zim showered shareholders with cash. But when rates came back to earth, those profits and the huge dividends vanished. Zim's dividend policy is variable and tied directly to its profits, which makes the income unreliable. So Zim doesn't go on our list. Instead, it serves at a critical lesson. A company's past dividend history is not a guarantee of its future payments. This is why our next step is the quality check. And this is the most important part of the whole process. So having a list of companies that pays in June and July is just a start. The real work that separates successful income investors from people who get burned is the quality control. So a massive dividend from a weak company is a trap. It's a siren song luring your portfolio into the rocks. Special shout out to OG Kicks. So before any stocks make it into our final portfolio, it must pass a dividend safety limits test. This is arguably the most important matrix for dividend safety. It tells you what percentage of a company's profits are being used to pay the dividends. For a standard corporation, I generally look for a payout ratio below 60% of the earnings. This shows that the company is keeping enough cash to reinvest in the business, pay down the debt, or build a buffer for tough times. However, we have to be smart and use the right matrix for the right companies. Real estate investment trusts don't use earnings per share. Use funds from operations, FFOs, which is a much better measure of a real estate investment trust cash flow. A rule of thumb, I look for a payout ratio based on FFO that is below 85%. BDCs. The key metric here is net investment income, NII. Since BDCs are required to pay out at least 90% of their taxable income to maintain their status, a 90% payout ratio isn't a red flag. It's the business's model. The real warning sign is when the dividend starts to exceed the NII. So I want to partner with companies where the dividend is a core part of their philosophy. The gold standard is the list of dividend aristocrats and kings, companies that have raised dividends for 25 plus and 50 plus consecutive years. But even outside of that elite group, we can look for consistency. A company like Realty Income shows a deep-seated commitment with its decades-long history of monthly payments and frequent increases. In contrast, a company that cuts its dividends at the first sign of trouble tells you management sees the dividends as optional. Companies like Main Street Capital have a long record of maintaining or growing its monthly dividends. And it also pays supplemental dividends when business is great. That's a shareholder's friendly approach. A company can look great on the surface, but if its foundation is built on a mountain of debt, it's a house of cards. So I look at the debt to equity ratio and, more importantly, the company's credit rating from agencies like S&P and Moody's. An investment grade credit rating like BBB minus or higher is a strong sign of financial strength. So let's have a frank decision about high yield stocks. The allure of a 10%, 12%, or 15% yield can be intoxicating, but yield is almost always direct reflections of the risk. So take the mortgage real estate investment trust like AGNC Investment Corp. I'll give you this one. These are often the highest yields. Right? These are often the highest yield stocks out there, but they can be yield traps. Their business is to borrow short term to buy long term mortgage assets. Their profit is the spread. This makes them extremely sensitive to interest rate changes. Their performance is highly dependent on the rate cycle. And many investors have been lured by double-digit yields only to face dividend cuts and price declines. They are not buy and hold investments. They are tactical tools for investors who understand the immense risk. So you're getting these types of real estate investment trusts to have short-term, fast growth of your portfolio for the long-term, stable growth of the other 17 stocks that we had grabbed. So remember when I told you that we're averaging 15% because the highly volatile, highly risky stocks that do guaranteedly pay dividends that might be paying over 20% return are utilized as cash generators to fund the rest of the portfolio that might be giving out like 3 to 5% return on investment, but those are going to be more stable blue chip growth stocks, right? So the complex strategy was a lot more keen than most people actually realize. Now, the next BDC that we mentioned, Maine, as a quality example, but the sector also has names with more controversial track records. The risk here is the credit quality of their loan portfolios. So if a small businesses that they lend to start defaulting, their income and the dividends will dry up. So cynical sectors like shipping, we already used Zim as our cautionary tale, but a company like International Seaway, which is one of the ones that's coming up soon. And you'll see all of the dividend dates projected in the membership because I had put those up already. You should see May already up there from June all the way up there from April. At the end of April, we put May and June up there, but now I just put up July or June and July. So you're going to see those popping up right now for the beginning of June. But International Seaway is one of the ones that's coming up. This can also provide huge income, but it's tied to global tanker rates, which is why I told you to grab it, because tanker rates are an issue with the conflict in Iran. The dividends can be a firehouse 1 year and a desert the next. So you can have a huge windfall 1 year and not so much the next. So that income is not stable or predictable like realty incomes. By applying this fourth part, limited test, we can filter out initial lists down to a curated watch list of quality income generators, which is one of the ones that I put into the membership. Highly volatile for short-term gain and highly qualified for growth. Now, for the fun part, assembling the machine. Only one or two of these is fine, but the real power comes from strategically combining them all. The structure is everything. So here are three models for different risk tolerances. Model number one, the conservative income portfolio. Your goal here is going to be to prioritize the safety of principal and a high predictable income stream. This is going to be for the investor who wants to sleep well at night. Allocations of 30% foundation to short-term treasuries. We start with a solid anchor like the iShare 1 to 3 year treasury bond ETF, SHY. It won't make you rich, but it provides a cash to invest, to reinvest during the downturn. I'm gonna put this one up there. This one actually might not be in our list, but this is one of the ones that I did research on recently to cover, to pay attention to for this particular hypothetical portfolio. Now, 25% would go to core dividend ETFs, and an ETF like Schwab USA Dividend Equity ETF, which is at SCHD. This one is in our list, definitely. This gives you instant diversification across dozens of quality dividend payers. 20% go to high quality real estate investment trust. So this is where we put our blue chip monthly payers like real estate or reality income, stag, and other such. And then 15% dividend growth into blue chip companies. And this is going to be where a company like Broadcom, AVGO comes in, providing both income and long-term growth. 10% tactically goes to the quality of BDCs, where a small target allocation to top tier BDCs like Main Street Capital to boost yields with the quality operators. Now, model number two is going to be a balanced portfolio, balanced income portfolio. A goal here is going to be to blend a steady income and higher growth potential. So we're taking a bit more calculated risk for a better yield and a total return. Your allocations for something like this would be 20% defense ballast. So we reduce our treasury holding to put more capital to work. 25% core dividend ETFs, and this is going to remain a core diversification tool. Then 20% diversified real estate investment trust, where we keep our high quality monthly payers and perhaps add a slice of a different real estate investor trust subsector, like residential apartments with excess property trusts, right? Let me give you guys, because this one's in our list too. Then we have 15% that goes to BDCs. Now we increase our allocations and maybe splitting between our top tier names like Maine and another solid BDC. 10% goes to some of those cyclical incomes, which is energy and shipping now. And we can introduce a carefully managed position in a quality energy producer like Cord Energy. Right? In addition to shipping companies like International Seaway. Oh, it says that. You should put it back in there. There it is. So, let me put it to YouTube. We understand that this income will be lumpier, but often higher yield potential. Then you have 10% dividend growth, where we maintain a position in growth powerhouses like AVGO, so that we see a lot more results from our portfolio. Now, portfolio three, this is going to be the aggressive income portfolio, right? And you want to use caution with this one. You want to be able to watch your portfolio regularly when you're dealing with highly volatile risk. So this is not for beginners or for the faint of heart. This is for experienced investors who understand the risk and are using this as a smaller tactical part of a much larger portfolio. The yield is massive, but so is the risk of capital loss. Allocations of 40% or higher of high yield tactical holdings for mortgage real estate investment trusts and BDCs. This is going to be the gasoline to the fire. So a large bet on high yielders like AGNC and a riskier BDC like Prospect Capital, that is also a monthly payer, Orchid Island, that is also a monthly payer. You get to put some on these. We're explicitly chasing double-digit yields and acknowledge that this part of the portfolio will be extremely volatile. The goal is to capture massive cash flow for a specific period, not for the idea of long-term stability. Okay? Now, 20% dividends go to ETFs. Even here, we want some diversification. Some going into things like Global X Super Dividend US ETF, which has a ticker of BIV. Okay. This is going to fit, but we recognize that it holds higher risk names in itself. Then we have even more 15% for those Silico high yield energy dipping companies. Now, since we're increasing our bet on the Silico income, we're recognizing that we're going to be dealing with a lot more volatility. We're going to go to 15% dividend growth, where we still keep a growth component, and then 10% to defensive balance. And this is going to be the fire blanket, a small allocation of treasuries. In this portfolio, its role is purely as a fire blanket, a small source of stability in a sea of volatility. By choosing one of these models, you're no longer a passive stock picker. You are an architect designing a machine to generate a surge of predictable income during the summer window. Now, for those of you that are in the membership, I've already gotten one of the most successful, in my observation, volatile portfolios that will produce the growth that you're looking for long-term growth over, I do believe, 10 of those stocks, where the other like 7 stocks are the high volatility that gives you the high cash flow that allows for you to reallocate cash flow into growth, where all stocks pay dividends, but some stocks pay more dividends than others. Some stocks give more growth than others. So even under the unlikely circumstance that the high dividend paying stocks get a dividend slash, you still have the massive growth in dividends from other stocks. Worked out the kinks that other people don't pay attention to. So what is the big takeaway? The June and July dividend window isn't some secret market hack. It is a deliberate, intelligent strategy, right? It's going to be about shifting your focus from the chaotic noise of the market prices to the rhythmic, predictable pulse of cash flow, especially if you're trying to retire. It's going to be about turning a source of anxiety into your own personal income factory, where money is being made for you, not because of you, right? You're no longer getting paid for your presence. You're getting paid because the money is still there, right? While everyone else is guessing what the market will do next, you will always have a plan, because I always have a plan. And I put out quite a few of those plans into the market, into the membership on a regular basis. Now, you will have engineered a system where you know yourself with a high degree of certainty when your next dividend paychecks are scheduled to arrive. In a world of financial uncertainty, that kind of predictability is the ultimate form of power. Um, and one of the things that I got to tell you guys is that there's a second step to knowing when your money's going to come, because the dividends are released into your account, in your brokerage account, on certain days. But you can predict when you get the money, because after the money is available for deposit to your bank account, you can then release that money to your bank account. You can, recognizing that you're going to get last month certain dividends before the first, you can schedule automatic deposits. Well, I got to double check on Stash App. I don't think Stash App does automatic deposits, but you can manually set up on Stash App the ability to deposit all of the available capital on a specific date where you guaranteedly get your money. So let's say that, because a lot of the real estate investment trusts wrap themselves up on the last week of the month. They typically pay on the first and second week of the following month. You may decide to put all your money in your bank account on the 15th or the 20th of the following month. So if you're looking at real estate investment trusts that are wrapping themselves up between the 20th and the 31st of the month, and you are having that money set up in a way where you're going to have it deposited into your account for the 20th of the following month, you know that 100% of the dividends that are going to come to you for last month will go into your account next month, or this month, might I add, because we're in the last week of May. And if all of your money is going to be available to deposit by the 15th of June, and you're going to do a deposit on the 16th or 17th of June, it's going to clear your bank on the 20th of June, then you know that your money is going to hit your bank account every month on the 20th. If you're paying for June in May, and when you get paid in June, you're paying for your bills in July in June, you don't have to worry about where your money is going to be at on the first, because the first, all of your bills were paid up on the 21st of last month. So you don't need to give a shit about what's going on between the first and the 15th, because all your shit is already taken care of. That type of power gives you peace of mind that not too many people pay attention to. He said, I just got that notification that you're live 10 minutes ago. I told y'all YouTube is acting up, bro. I told y'all YouTube is acting up. We've been live for 3 hours now, and YouTube just sent you a message that says, hey, he's still live. And you know what probably happened? They took me back out of the restricted mode, because when I was over there talking about politics yesterday, they put me in the adult section, and then they took me out of the adult section and put me back in the everybody section. And more people are jumping into the live right now. Oh, look, see, this is why I make money off of my stock account, not trying to make money off of YouTube. Now, I don't mind making money off of YouTube. I love when I get money from YouTube, but I pay more money into YouTube than I get out of YouTube, when YouTube pays for itself eventually. But at the end of the day, YouTube is not my primary source of income. But it would be nice to reach a point where YouTube is making more money than my brokerage account for me to sit here and talk to y'all. But to help you guys get started, I've already put up a list in the membership, but I'm going to give you another one that is going to be the summer income surge watch list. And I'm going to be putting that up later this week, because we do have a large quantity of stuff that's already scheduled to be released already. So I'm going to be throwing this into that watch list. It's going to include the exact stocks that we discussed, and the key safety metrics, and the payment dates to help you guys begin your research, so that you can go and get that stuff out of the membership on your own. And I put links for this stuff into the membership so that you guys can find it. Now, if you guys want to follow along as I track the income generated by these models portfolios through June and July, and we keep giving you guys further updates about how these things are making me successful as well. make sure that you take the opportunity to subscribe to the channel and hit those notification bells, because eventually YouTube will tell you that I'm here. And you don't want to miss the follow-ups, because we're going to be reviewing the real world cash that this strategy produces on a monthly basis. So you guys want to stop waiting for the market to give you guys permission to build your wealth. You want to start building your wealth today, building your income generating machine today, so that you are no longer getting paid for your presence and you are simply getting paid because your money is still out there being used on your behalf. Right? Now, that is all I got for you guys for today. This was a really long show. I really appreciate everybody that came in. Special shout out to OG Kick, Steven, Michael, FX Trader. I really appreciate y'all coming to the show and giving us all that extra performance. You guys are fantastic. Especially since y'all do y'all research and y'all come and y'all talk to me about, like, hey, man, I've been doing some digging. I want to know what you think about this. I love that. I love that. Because you've been doing digging on some things, and there's some things that I've been doing some digging on. And then when we cross paths with the same knowledge, like what FX Trader was telling me about the national average of the debt that's outpacing, I was just about to post that up. We're all on the same page. But that goes to show that like-minded people have forward-thinking discussions, which is something that not a lot of podcasts do, because a lot of podcasts dwell on the present and the past. They complain about the present sucks because of past behavior, but nobody ever talks about what to do in the future. We are forward-thinking in the present, talking about presently what things are changing so that we can prepare for the future, so that the future doesn't suck the way the past sucked, right? And that's going to change the successful from the unsuccessful, because those of us who plan for the future and put forth effort for the future are going to see ourselves more successful than those of us who dwell in the past, linger in the present, and take no actions for our future. So with that being said, I'm going to start by saying, ladies, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. And then fellas, I give y'all this information to make y'all higher value men, not just by increasing your financial status, but also increasing your decision-making skills, right? You have to pay attention to the things that are impacting your life. You have to find the things that you are directly in control of, the things that you don't like, and put forth effort to make those changes. Then navigate around the things that are outside of your control. Ladies, while this is a male-driven podcast from the male's perspective, you too can make yourselves higher value women by proactively finding out what your 20 and 30-year plan is and reverse engineering that to your today style, and proactively putting forth that effort into accomplishing those goals while keeping your eyes and ears open for that potential suitor with the drive, the dedication, the personality, the characteristics, the motivation, the integrity, the momentum to achieve goals. Observe his goals and see how his goals match with your goals, because if y'all can come together, y'all don't have to have the exact same goals. But if the two of y'all can accomplish all those goals together, two people can make it to $1 million faster than one. But it requires for you both to be forward thinking, for you both to be long-term satisfaction driven, not short-term gratification driven. Because if one of you is short-term gratification driven, which is usually the ladies, you're going to spend today what could have given you that same lifestyle 10 times better tomorrow. For those ladies who like to travel the world, why waste every extra dollar that your man get to go traveling once a year when y'all can put this money away, and when y'all retire, y'all can travel once a week? The difference is delayed satisfaction versus short-term gratification. Why impress your friends with a G-Wagon that you got to pay notes on today when you can buy cash up front a fleet of vehicles that you be sitting in your yard in 20 years, where you can pick and choose based on the value of the usage of the vehicle, which ones you're going to own, versus the value of leasing the ones that you can use as a tax write-off off of the profits that you're making off of all of the stuff that you've done over the past 20 years. When you're making money make money for you, you have to understand tax deductions are only available for people who make taxable income. You don't deduct taxes from nothing. having money coming out of a business that utilizes the tax deductions from the profits that are being made. You have to have profits. To travel the world as a business expense, you have to be making enough money to travel the world. So for those ladies who like to travel, you should be building a future that produces the quantity of capital where you can travel. Because if you're living paycheck to paycheck, you probably travel once every 5 years. And you ain't traveling to different countries around the world. You're getting on a cruise ship and driving around American waters and going back to America. You ain't went nowhere. You took a plane ticket from one side of America to another side of America. You ain't going nowhere. But if you really like to travel, why not build a future that generates the quantity of capital where you can spend $20,000 every 3 months in a different country? When I say every 3 months, I'm talking about every 3 months in the same year, not $20,000 once a year, once every 10 years. I'm talking about $20,000 every 3 months in a different country, every 3 months, where you go to 4 different countries a year. Right? But that's $80,000 a year. That is not your standard living situation, which might require you to generate $100,000 to $120,000 a year. And if you're talking about after taxes, you might start generating $150,000 to $170,000 a year. And if you're looking at 10% return on investment, not the 15% return that we're dealing with, you will be looking at over $1 million, $1.5 million to live that kind of lifestyle. Think about it now. Where do you want to be at when you don't want to work no more? And what do you got to do for your money, not his money, your money, to make more money for you so that you don't got to try? Because even if y'all pool y'all money together and split the difference, put all the money into the trust and split the difference, the fact is that there's supposed to be more money coming back to you than what you put up in the beginning, so that you don't have to try no more. That is true retirement. No longer having to try, no longer having to apply yourself. Right? So that old saying, work hard, party harder. You work hard the first half of your life so that you can party harder the second half of your life. Not work hard Monday through Friday and then spend all the money that you earned on Saturday and Sunday and be broke as fuck on Monday. That's not success. Okay? You struggle week to week, and we have to change that mentality. If you're still struggling in 2026 and you've been grown for the last 26 years and you're still struggling in 2026, you have to ask yourself, how many fucking mistakes have you made to still be struggling after 26 years? Right? To be 26, to be an adult for 26 years and still be struggling. Now, y'all know who I'm talking to. Everybody who was born before 2000, who have been grown for the last 26 years, and you're still struggling. It is time to stop. We need to start putting our money in different places so that our money is making more money for us, so that over the next 10 or 20 years that we can fucking stop. Because in 20 years from now, I'll be 66. I don't want to be having to get up in the morning or overnight or whatever and having to do nothing for nobody. I don't want to have to answer the phone because I have contracts that I have to fulfill and clients that I have to satisfy. When I'm 66. I want to be in a situation where I only have an alarm clock to remind me to do something that I really wanted to do. Or have absolutely no alarm clock, where I get up when I feel like it and do it when I feel like it. And if it ain't there when I get up, fuck it, I'll do something else. That is a stress-free life. And I think that that's what a lot of people hope to have when they get older, but they don't actually strive for it. We need to start striving for that. Now, that's all I got for you guys for tonight. I'm going to start by saying thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow night.
respects my personal command. I'm not mounted on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.